AUM has expanded 8% sequential, 34% YOY. That's led to a very sharp expansion even with regard to NII because or net interest income, because your margins have held steady at 11.6%, and therefore your NII growth reflects largely the loan growth, especially in gold. Even non-gold portfolio growing healthily. It grew at 12% QOQ, 131% YOY, of course on a lower base, but nonetheless that growth is extremely robust. And that's reflecting both on net interest income as well as profit after tax, because largely your credit costs have remained flat, and of course on a slightly higher base they've remained flat, so maybe that's a bit of a concern, but nonetheless your profit after tax therefore is showing a very healthy growth overall. And just the growth number really impresses, but that's not it. You've also seen, as you were pointing out, gold prices have gone up, and therefore you've seen a little bit of inch down with regard to risk on gold assets, and therefore your NPA ratios though have remained steady. You've largely seen your coverage with regard to the gold held has obviously, or the loan to value as they call it, has obviously declined because the value, the denominator factor has gone up quite sharply, and therefore largely a safer asset where you're seeing very strong numbers. So what Nuvama has done is it's gone ahead and upgraded the target price on this one, and it's a large upgrade. The target price currently was sitting at sub 2000, now sits at 2500 plus, and we've had a couple of upgrades on some of these gold financiers, so keep your eye out on this one. Interesting set of numbers followed by a very interesting upgrade as well.
Harsh, positive read-through for Manappuram as well. Very quickly, 30 seconds, Harsh. Okay, I think we've lost Harsh, but I would suspect that this read-through for Manappuram as well. So keep an eye out for Muthoot and Manappuram. This could be very interesting, both of these really. Okay, now on to some more numbers as well. And interestingly, autos had a bit of a mixed bag today, right? Bharat Forge not quite so, but Ashok Leyland, very strong numbers.
Yeah, extremely strong numbers. And in fact, what stood out for me was in fact the realizations that improved in the quarter gone by. We've got the management. In fact, we've got Shenu Agarwal who's joining in to talk about that soon. Before that though, let's take you through the watch list that we have for you. And we've got some of these stocks that we've already spoken about. Let me first take you through Kotak Mahindra Bank, right on top of the list, arguably the stock of the day. Lemon Tree Hotels, strong upgrade by Macquarie. It's seeing an upside of 63%. Chalet Hotels in the same space. Some of these hotel stocks getting upgraded, and in fact Macquarie seeing a 58% upside here as well. Suven Pharma was on my list. Strong set of numbers, 77% rise in the bottom line. Entero was something that Neeraj spoke about, and we had a detailed update from Varsha as well. The EBITDA has grown very strongly in the quarter gone by.
Absolutely. The next one on our list, we have two other counters that we are watching out for. PN Gadgil, profit has risen, margins have expanded for the counter. So another gold company which could see positive returns. Premier Explosives as well, a strong number from the defense pack. The EBITDA has tripled and the PAT has seen a growth of almost 5 times. So two positives. The other two negatives are a Bharat Forge. Earnings have clearly missed street estimates, and to actually sit with this one, you have a Ashok Leyland, which will see an opposite reaction probably, and a Balaji Mines on the weak set of numbers that will be in focus today.
All right, let's turn to the management conversation that we've lined up with Ashok Leyland. Strong set of numbers, as Neeraj pointed out. And we've got Shenu Agarwal, the Managing Director and the Chief Executive Officer of the company, joining in. Thanks so much, Mr. Agarwal, for taking the time. Let me start by asking about realizations, because that to me, and that improving is what seems to be the key reason for the expansion in the margins. How did this come to pass? Can you talk us through that?
Yes, so we have been very focused on profitable growth, and we have laid down various levers to achieve that. One of those is better realizations, which is both through pricing and also through improving our mix. We do believe that we have a very good headroom for improving our mix. So some of the segments which are more profitable than the others, we are definitely focusing on them by premiumization of the products and also by introducing some new products that give better performance and better revenues for our customers. Yeah, so that is one thing. The other thing is also cost optimization. This is our third year now in a row where we are deeply looking at rationalizing our cost. And this is a whole spectrum of cost, whether it is material cost or indirect cost or any other administrative cost, warranty cost, people cost. So we are looking at each and every element of the cost. And we have many cross-functional teams that are looking at each of these costs and trying to see how we can cut waste, from the cost and keep the good cost. So that is the second lever. And the third lever is definitely, there is a kind of a mission mode to enhance our service reach and our service effectiveness. Because we do realize that especially in the MHCV market, while product is important and will continue to remain important, but equally important is our ability to serve the customer and keep their vehicles on the road. Right. So I think it is a combination of all the three factors that now for several quarters we have improved our margins.
Okay. You say that the product mix has improved, Mr. Agarwal. Could you take me through how this took place, though? Just take us through the breakdown of this improvement.
Yeah, so I think there are two additional positives in quarter four. Number one is that we have been able to fetch some price increase from January 1. Right. So that is going to continue to help us even more as far as Q4 margins are concerned. And the other thing is, like I said, when it comes to mix, we have two levels of mixes that we are focusing on. One is the mix within the particular business unit. So, for example, within MHCV, there are certain segments, which are more profitable than the rest. And our focus is to improve, to grow our volumes more in those segments. And also, we have five different business verticals, and then again, they are at different levels of profitability. So, for example, defense, for example, spare parts, power solutions business, these are very high margin businesses for us. And to that extent, even the international operations business is very high margin. Right. So it is a combination of both. Within a particular BU, how do we improve our mix? And within the overall spectrum of all the businesses, how do we go for higher margin businesses?
Now, the margins, as I understand, you pointed out, are expected to rise year on year in the fourth quarter as well. But in particular, because you've undertaken that price increase as well on the 1st of January, how much is the benefit from that? And what is the trajectory heading into the next financial year, Mr. Agarwal?
Yeah, definitely. We will try to beat our YOY margins every quarter. Like I said, quarter four is looking favorable right now, both in terms of operating leverage, because market is doing better. January was a very good month as far as market is concerned or industry is concerned. And then on top of that, our continuous focus on cost optimization, mix improvement, getting better prices from the market. So I think the story is looking quite positive for quarter four right now.
So, but take me through the trajectory heading into next year. Are you comfortable with this range, or do you see this improving further in the next financial year?
Look, our medium-term goal, is very, very clear that we want to reach mid-teen EBITDA margins. Now last year we had touched 12%, and therefore this year we would like to post a better margin on the whole year basis, better than 12%. But I think within next 2 to 3 years, the way we have laid out the roadmap to reach that mid-teens, and we are executing it very, very sharply, we are still very confident, that within that 2-3 year time frame, we should be able to reach that mid-teen EBITDA margin. Now, as I said, the levers are going to be similar. One is that how do we build more premiumization in our products by offering better features, more performance, better reliability. Then the second would be how do we continue to optimize our cost. whether it is material cost, indirect material, or any other kind of cost. And the third would be how do we expand our customer service reach and keep our vehicles on the road more and more. Therefore, customers can earn more from the vehicles. So all the three levers we will continue to focus on.
The other aspect is the tailwinds on the input side, Mr. Agarwal, and that seems to have played a part as well in improving the margins in the quarter gone by. Will this continue to pan out though, heading into, of course, this quarter and into the next financial year?
Yeah, listen, as far as commodity costs are concerned, those have been very favorable throughout this year. In quarter four also, we don't see any change there, right? Going into next year, there are some chances that commodity prices may increase to a small extent, but we are not looking at any major shift in the commodity prices going into next year as well, right? So to that extent, we are quite comfortable. As far as the pricing is concerned, we have taken a price hike very recently, but I think more of mix improvement is our agenda. Because we see that there is a lot of headroom in mix improvement. For example, tipper is a very remunerative segment for us, and we see that we have potential to increase our market share in tippers. And tippers also, with all the government capex now flowing, we also think that the tipper market would be good. Now, this is just an example, but like I said, there are segments where we make more margins, and the focus is to continue to grow in those segments more than the rest, and also look at non-CV businesses where the margins are higher.
All right, Mr. Agarwal, thanks so much for joining us this morning and for speaking to NDTV Profit. All right, Ashok Leyland rewarded yesterday in trade, Neeraj, and let's see if that continues today. Certainly a very strong number.
And also, Volvo Eicher commercial vehicles. In Eicher, VECV was the standout feature. I wonder if the CV companies are quite turning the
MNHCV space seems to be turning. That's really what everyone's taking from this.
Let's wait and watch. Let's put the question to our experts as well. Nilesh Jain, Head AVP of Technical and Derivatives Research at Centrum, with us on the charts and the derivative positions. Aditya Shah, founder at Hercules Advisors, with us on the show as well. Thank you so much, gentlemen, both of you. Now, usually we start with charts and the Nifty call, but since we just finished Ashok Leyland, Aditya, I'm inclined to come to you and just understand, what did you make of what the CV and the MHCV space companies are doing, have done in quarter three and are saying about the times ahead? Is it making you constructive on an Eicher, maybe a Ashok Leyland, who knows, maybe even a Tata Motors?
Good morning, Neeraj. So I'm positive on the MHCV space per se. I would be very constructive firstly on Mahindra and Mahindra, because it's four-wheelers as well as tractors as well as a little bit of MHCV as well. So the entire space will do pretty well over the period of next 1.5 to 2 years. As the economy starts to turn little by little, the tax cuts will start to play out in the next 1.5 to 2 years, and the economy slowdown will get abated with a lot of measures that the government is really taking. So from my perspective, the number one pick within this pack will continue to remain Mahindra and Mahindra, as the company is doing exceptionally well. All of this is tied to the economy. As the economy will do well, all of these companies will also start to do well. So constructive on the entire space. Mahindra and Mahindra will continue to remain the top pick.
Okay. M&M remains the top pick, not necessarily for the commercial vehicle reasons alone, according to Aditya, but a clutch of others. Nilesh, good morning. And did yesterday seem like a day of resilience to you, or just another day in the series of downticks that we've seen? What would be your positioning be today on open, on the Nifty Bank?
Very good morning, you. Good morning, everyone. So yesterday was an interesting setup that we have seen. Nifty has found a very strong support at 22,800, and it could be a potential reversal candle, but still we need a confirmation which will come today. Yesterday was a doji candle after 5 days of constant decline. There was a little bit of respite that we have seen, but still I would advise to remain cautious till time we don't cross 23,400 levels on the upside. So it can be merely a pullback that we may see today. And today being a weekly FN expiry for the Nifty, the data suggests that 23,000 strike on the put side yesterday has witnessed fresh put writing followed by 22,900. At the same time, the call writers are still active at 23,100, 23,200 strike. So looking at the setup from expiry point of view, we may see a positive expiry in the range of 23,000 to 23,150. But overall, I would be a little cautious in the Nifty. Bank Nifty is giving more comfort, given the kind of a setup and performance that we have seen recently. Yesterday as well, we have seen a good close above 21 DMA. So that is a kind of positive setup that we have seen in the Bank Nifty. We are bullish for upside move to continue towards 49,800 or 50,000. With a stop loss below 49,000 on the closing basis, a long trade can be initiated at current level and on declines.
Right. Thanks, Nilesh. So, Nilesh, are you saying that if there is that cautiousness that continues to remain, however, the trend reversal that could come in, how much certainty is there whether it will sustain or not? What are charts indicating?
See, there are very high possibility of Nifty not slipping below 22,800. So that's number one. Number two, looking at the data, I would wait for a breakout to come in about 23,200. At least that's the first level of confirmation that we'll get that Nifty has formed a short-term base. But as of now, it's into no trading zone, I would say. A breakout about 23,200 can be a good bet to initiate on the long side. That will be the first trigger of a confirmation. But as mentioned, Bank Nifty is giving a confirmation, so there are a very high possibility of Nifty bottoming out at these levels. But it is advisable to focus on sectors and stocks. As of now, it is better to stay away till the time we get any confirmation. The volatility index in Davix, if you just look at IVs, which are constantly moving higher, it needs to cool off below 14 to give more comfort to the bulls. But as of now, the kind of momentum that we are witnessing in IVs are also a cause of concern.
Okay. Now, what about your ideas for the day today, Nilesh?
So I have two buy recommendations. So we have seen a good move in Tata India yesterday. After budget, we saw some profit taking. Now, once again, the momentum has begun. So overall setup in the Tata India looks positive for a follow-up move to continue towards 1395. So that's the immediate target, followed by 1450. But the first target would be 1395 with a stop loss below 1324. Tata India can be bought at current level. The another space that is looking very attractive is NBFC. So NBFC, be it Bajaj Finance, SBI Card, Chola Finance, all these three stocks are looking attractive. But within these three stocks, Chola Finance will be our preferred bet. Yesterday, it has formed a good reversal candle exactly from the breakout zone of 1320. So Chola Finance looks attractive for 1401 target on the upside. With a stop loss below 1328, it can also be bought.
It's time for a short break. Gentlemen, do stay with us, and viewers will be back on the other side. We've got lots more stocks to discuss ahead of start of trade. Do stay tuned.
के चैलेंजेस होंगे
All right, back with India Market Open right here on NDTV Profit, and it looks to be a start which could be, well, I don't know, mixed if you will. The question only is, will it stay that way or could it improve? For now, 34 odd points. Let's see if there is more in store. You know what could give a fillip, of course, is banking, right? And we'll talk about Kotak Bank in a moment, but we've discussed Kotak Bank for a little bit already. Aditya, I'm inclined to ask you if you believe ICICI Bank could also benefit materially by this whole thing of ICICI Prudential AMC listing at some point of time, right? I mean, they've just announced the plan. It could well take 12 months. What's the sentiment impact on ICICI Bank, you reckon, because of this?
Positive for ICICI Bank because this is going to value unlock. And similarly, ICICI, Kotak, Kotak, SBI, all of them will have to list their AMCs and insurance arm at some point in time. So it is value unlocking for all of them. Particularly for ICICI Bank, I think that it is the market leader now since HDFC Bank is really struggling with the margin issues and the integration of the merger. ICICI Bank, meanwhile, is really very strong. The asset quality continues to remain very good and the loan growth also continues to be really very strong. So this is positive for ICICI Bank and for all those banks who have an AMC and an insurance arm attached to their banking stock.
Okay. So, Shrikant Chauhan joins in and we'll talk to Shrikant Chauhan about everything else but Kotak. Obviously, we can't ask him about Kotak. But Nilesh, before we thank you, because Kotak and ICICI Bank would both be in focus, let's assume both of them start gap up. Would you trade either of them after the gap up?
Right. So as at the beginning of my commentary, I mentioned Bank Nifty is looking attractive compared to the Nifty index, and we may see an outperformance to continue in the Bank Nifty. On the back of that, Kotak Mahindra Bank is our preferred bet within the banking space. We continue to remain bullish for upside target of 2,000 plus. So it can be bought at current level, can also be bought on the gap up node, but provided it should open somewhere on 1960, 1980. So there's also a good range to enter. 2000 on immediate basis and 2080, 2100 could be the next potential target. Stop loss should be placed below 1900, can be added on gap up and can also be bought on declines.
Okay. Nilesh, we'll leave it at that. Thank you so much for taking the time out and being with us. Really appreciate your time. 15 seconds left to pre-open session. Let's see if we indeed have a good start or no. But Shrikant Chauhan, I'm inclined to ask this to you. If we have a bit of a gap, and yesterday's price action wherein the index almost broke back into the black or the green, are you inclined to take a positive trading call on the Nifty or the Bank Nifty today?
Good morning, Neeraj, and good morning, everyone. It's a pullback to the recent sell-off that we saw from the highs of 23,800. So in just 6-7 trading sessions, we saw a deep decline in the market, and because of the overall oversold activity of the market, we saw a smart pullback on Wednesday. But yes, if we see the market is opening somewhere close to its previous highest level of 23,100 or 150, then there we should look for taking some profit or long position if there are any, or we should look for reducing some positions because it's a pullback. So till the markets are not sustaining above the levels of 23,200, we cannot even take short-term trades. But in case if we see the market is dropping quickly to the levels of 23,000, then there we should look for taking some contra bets with a stop loss at 22,900, because I'm expecting market to remain in a range today, and on the dismissal of 23,200, yes, then we can see some upward activity, but it's a pullback. So max I'm expecting 23,500 sort of levels, and on the downside 23,000 is going to act as support for the market.
Okay, 23,000 as support. So not too far from that mark, and certainly something to watch out for. But we've talked about Kotak Bank being arguably the stock of the day. Let's see how it does right now. In fact, so what more can you say to that? But let's see if that continues to be the case when we fully open. Let's go to Harsh now, though, because he's put together some information for you that talks about how rapidly this business was growing before the curb came through or the ban came through, and why this could be such a significant move for Kotak Mahindra Bank. Harsh?
Yeah, absolutely, Alex. So 2 restrictions placed. One was on the credit card business from onboarding new credit card customers. Let's first talk about that piece. In terms of loan growth for 9-month FY25, we saw a loan growth of in Q3 of roughly 16%. 3% QOQ was the loan growth. Overall, Credit card though, growth was just 2% YOY, negative 2% sequential, and when I'm looking at the 9-month number, it was in fact negative 9 months. So before supervisory action, you saw credit card AUM at 14,505 crore. The current credit card AUM is just 14,117 crore. So this has been a drag with regard to the overall business of Kotak. That's what I'm trying to highlight. This business will now get booted, which is a key positive. Now let's talk about customers, because online onboarding of customers now allowed. Over the last 9 months, Kotak has only been allowed, or maybe 10 months, Kotak has only been allowed to onboard customers through physical channels, which is through bank branch. So therefore, what we've tried to do is we've tried to cull out the customer growth over the last 3 years. 2.6 crore customers in FY21, 5 crore customers in FY24. The growth clip even in the last year was around 22% on that high base, and 24% CAGR growth. But in the last 10 months, the growth has just been 4. And that has essentially impacted your overall loan growth as well, likely. And because of that, deposit growth and loan growth have been muted. Look at the 5-year CAGR on advances and deposits, and you look at the 9-month growth, absolute growth, 9 months of both of these businesses. It's far slower than the 5-year average. Likely pick up in some of these numbers, and which is why you're seeing a bit of a zing on the stock. Last off, what analysts are viewing this as, those are some of the target prices on your screen, including the upside by analysts on the street.
Thanks, Harsh, for getting us the details. So what's interesting over here is the kind of reboot that we are going to see in terms of the credit card business from here on, and the target price. The highest one that we have is 2,330 by a Jefferies. And currently, you have the stock which is trading at around 2,000, at least in terms of pre-open, a 3% upside coming in there. But the next stock that is in focus is a similar field. You have SBI Cards. Let's pull up that one. The stock actually ended with gains of around 4% yesterday. Today, pre-open is indicating a marginal uptake. It is the big brokerage call of the day as well. You have Macquarie, which has gone ahead and upgraded an SBI Cards to outperform with 1,000 as the target price. You have Agam, who's standing by to get us more. Agam, what is making Macquarie positive on the company, and a good upgrade coming in on that one?
Certainly, well, Macquarie has upgraded. Macquarie's had upgraded our SBI Cards to an outperform, putting a price target of around 1,000 rupees per share. As per pre-opening currently, it's indicating, well, around 820, which means a 25%, near 25% upside in from current market levels. And among the reasonings mentioned here is that Macquarie feels that there is a tide turning for SBI Cards. They do suggest that channel checks are indicating credit card slippages to plateau at the moment. And they're also looking at credit card costs to come off by substantially over the next couple of quarters. They suggest that other catalysts include falling rates, easing liquidity, tax cuts, and RBI's incrementally moving towards and focusing towards unsecured loans are among the many reasons why Macquarie seems to be a lot more positive on SBI Cards, and hence the upgrade that you see here.
Thanks so much for getting us those details. Of course, let's talk about SBI Cards and a couple more. Srikanth, I'm not sure what your view on this one is, and so a stock also that we talk about, a different space entirely, Ashok Leyland was up and about yesterday, 7+%. Do you see any continued strength in this counter? Any view here?
Yeah, good morning, Alex.
Good morning.
Ashok Leyland, yes, absolutely, it is showing a lot of strength. It is holding above the levels of 200, and whenever there is fall in the market, and specifically in this particular stock, since last 1 year, if you see the overall technical pattern, most of the time after hitting the levels of 200, we saw recovery towards 240 sort of levels. And while looking at its quarterly numbers, commentary, and technical formation, I'm of the view that we could easily see the levels of 240 in the near term. But in the long run, the stock may even cross the levels of 260 because the overall primary trend of the stock is still intact. And it's a reaction that we are seeing to the rally that we saw in the past. So I am of the view that now the stock has completed its correction, and even at this price, it's a buy.
Okay. Even at this price, it's a buy. Let's see how it starts off. Remember, at a big uptick in trade yesterday. Let's see if it does that going ahead or no. I think the pre-open rates could be interesting for a lot of stocks. I mean, we'll watch out, of course, for what could happen to Muthoot and Manappuram Finance. Kotak Bank would be very, very interesting. And let's see if at the end of 7 minutes, it's still staying up on that. No, it's come off. So not a very wide gap up as well for Kotak, very interestingly. ICICI Bank is the other one. Let's see if that is having a bit of an uptick on that prudential listing. No, flattish, so nothing too dramatic. Maybe the healthcare space has the big winners. So Entero would be interesting to see if there is some upsides there. Maybe Godrej Industries could have some upsides. 3.5% for Entero, Godrej Industries, 2% higher. It's a very muted set of reactions that we are seeing. Aditya, coming on maybe an Entero or a Godrej Industries or a PN Gadgil. 3 numbers which looked very good amongst many others. Suven Pharma is also very strong. But did any of these stand out for you?
Neeraj, this is a market in which if you give good numbers, the stock is around 5%, 10%, 15%. That's the state of the pendulum that we are in. Market will not reward good results as well. That's how it is. PN Gadgil looked okayish kind of numbers. We are seeing a trend where the gold manufacturers and outsourcing of gold manufacturing is really turning on, and we are seeing growth of 25 to 30%. However, the valuations are not cheap here. Most of the stocks are trading at a valuation of Titan. Mind you, Titan is Titan. Titan's brand is much higher than any of these companies per se. But this entire space is looking really very interesting at a time when discretionary spending is slowing down. All of these companies are tending to do really well. So this is one space that I will really watch out for. If there is a good amount of correction within any of these companies, I will be buying.
Okay, so let's also talk about, Shrikant, your picks, because we didn't discuss that. We missed that out. What are you doing in trade today in terms of what are your picks today?
Yeah, I would like to go with a few NBFCs. There I'm seeing good amount of strength. Most of these stocks have fallen to their support levels and now again recovering back. A few of them are above their resistance level, like Bajaj Finance, which is currently around 8200 levels. There I'm expecting further upside in the near term. Broadly, I'm of the view that it is into long-term breakout. So eventually we could see the levels of maybe 10,000, 10,500 sort of levels based on technicals. But in case if there is a short-term view, then with a stop loss at 8100, we should look for creating some position with a target of 8400. We also like a few FMCG companies, in that Jubilant Foodworks. There we have a bullish view. The stock was actually correcting from the highs. But if we consider the technical pattern, then again it is back to the support levels of 620, 630. Again, from here, the stock can move to the levels of 760. I think it is going to spend time between the range of 760, 770 on the high side and 620, 630 on the downside. So at this level, it's a good risk-reward ratio to create long positions on Jubilant Foodworks.
Right. So Jubilant Foodworks, that's going to be in focus as well from a long position perspective. But let's quickly look at two of the other names. Suven Pharma, we've already spoken about. If you pull up that one, as well as a Natco Pharma, two of these counters that continue to remain in focus in today's session. Natco 14-15% downtick in pre-open. Shrikant, what are charts indicating for both these? What would you do?
See, in that specifically, if we see the technical pattern of Natco, then there, yeah, we are seeing a downward activity or maybe downward or lower opening. But I am of the view that the stock has completed its correction at 1100 levels. And today, if we see the stock is again dropping back to the same levels, then there we should look for taking some contra bit of going long instead of exiting out of the stock. I'm like, basically, if we see the overall, its fundamentals or maybe quarterly numbers, then seasonally we see most of the time this quarter as the muted quarter for the company. And if we consider the technical pattern, then there also we are seeing equal amount of reaction. So, close to 1100 levels, we should look for taking some positions with a target of again 1350, 1400 on the higher side.
Okay. What else? The clutch of other names which have come out with a fairly disappointing set of numbers, and or vice versa, and therefore could be interesting. Shrikant, picks notwithstanding, just from the financial space, would Bajaj Finance stand out as something to benefit? Because what benefits SBI cards also benefits Bajaj Finance in some sense. Do you like the and the company's done well? Does it look good as a trading play?
Yeah, absolutely. Like whenever we see relative performance in any stock, we need to go through with its like current fundamentals or fundamental developments and all. And if we consider the fundamental developments for company like Bajaj Finance and SBI cards, then yes, they are favorable. And also if we consider their technical pattern, then they are doing much better as compared to their peers. Bajaj Finance especially is trading above its crucial level of 8,000, which is positive. With a very short-term view, keep a stop loss at 8,100. But if there is a medium to long-term view, then even at this level, it's a buy with a target of minimum 8,500, maximum could be 10,000, 10,500. For SBI card also, if we go through with its long-term technical chart, then it has spent nearly 2.5 years, close to 700 levels, and now it is reversing back. So there also, we could say that the stock has completed its downward correction, and now the stock is ready to move towards the levels of maybe 1,000, 1,050. So both the stocks are really good, but yes, we need some positional view to buy and hold.
A quick view, Shrikant, on a couple of these hotel names. You can pick one out of the pack. Macquarie seems very positive on these, Lemon Tree as well as Chalet. Do you see any action here, any reason for you to go long?
I think, see, this space is doing really well. And whenever we are seeing correction in the stock, we see like specific buying interest from smart investor, because there we are seeing good amount of volume gathering. Lemon Tree, especially whenever the stock is falling to 125, 126, we see good amount of buying strength. And this time also, I mean to say yesterday, when the stock was around 126 levels, from there all the way to recover back. So there also I'm seeing some range bound sort of activity, but yes, it's a buy at current levels, more on dips. We also like Chalet, which is currently trading around some 670, 978 levels. There also the stock is very attractive. Again, we could see the levels of 850, but broadly we are bullish on Indian hotels and Lemon Tree with a view of at least next 3 to 6 months.
Okay. Stay on, gentlemen. We'll just open the markets and then come back to you on how you view the open per se. A lot of very interesting names in focus today. Remember, a clutch of stocks which came out of a very disappointing set of numbers. We'll try and talk about some of those as well. Bharat Forge might be something that we should highlight too. But here's how we're starting off. Flat though. Nothing dramatic, but flat, marginally in the green is not bad. Interestingly, banks are now perking up. I wonder if Kotak, etc. is starting to shape up after starting off flat. IT is okay, mid caps, small caps. Very quickly, let's get mid caps and small caps, and then, okay, 0.5%. Let's go to the heat map and see what Kotak Bank is doing. Is it in the list of the top gainers? No, the top 5, the top 10 don't have Kotak. Very interesting. Okay, now it is 2% higher. Sorry, my eyes were playing tricks with me. Alex, thank you for pointing it out. 1.75% higher for Kotak Bank. So pre-open started off flat, now building up a little. BEL is the other one. Finserv 1%, Wipro, BPCL, don't quite see an ICICI Bank on that, I'm sure of. It's number 13 on the list. Adani Enterprises, BPCL, Sun Pharma, Adani Ports are some of the others. But no standout movers aside of Kotak Bank, which is now up 2%. More green than red, which is good. Hero MotoCorp, one sore spot. HUL Titans, a bit of a pullback on consumption, a little bit of pullback on Eicher Motors as well. But no, on the large cap space at least, Alex, the big takeaway has to be Kotak. It didn't start off with a bang, seems to be building out. Let's see if we can actually build on from here, because almost every brokerage worth its salt said that this is a bit of a game changer for Kotak.
Oh, no doubt about that. And let's see if that builds strength. What we've seen over the past few trading sessions is that you have a change in sentiment sometimes very quickly during the session. Let's see if this pans out for Kotak as well as the rest of this pack that you see here. No big movers, as Neeraj has already pointed out. Let's look at the sectoral heat map. Let's pull that up and see what is moving, because as I pointed out, for yesterday's session, you had quite a few big movers towards the end of the session. At the bottom of the list, you once again have Realty, which is underperforming. It underperformed yesterday as well. But what's on top of the list? You have healthcare, you have pharma, you have media that's doing reasonably well. You have as well the PSU banking pack that recovered quite a bit of ground. It was a top recovery in trade yesterday, and it is in the green right now. Let's look at individual stocks very quickly. And Lemon Tree Hotels and Chalet Hotels stand out because huge upside seen by Macquarie. They've sent out a note, 63% upside for Lemon Tree, and you have 58% upside for Chalet. Certainly something to track. These are both reacting positively. Suven was on my list for a very strong set of numbers, 77% growth in bottom line, and the stock is up and about 4% higher in trade at the start. Entero Healthcare, this is something that we spoke about as well, and it's not reacting to what is actually a standout number. It's down about 0.5% at this point, and maybe some of the rub-off effect of some of its peers underperforming is playing out here as well. PN Gadgil, it's a decent start for a company that posted a strong Q3, and let's see if it builds strength through the day. Premier Explosives, was something on my list. It's a 5 times increase in the bottom line, 3 times, or rather, wait, I can't remember, it's 5 times increase in top line or 3 times increase in top line, but it's a multifold increase in top line, certainly, and that's certainly something that the street is liking. On the downside though, these are stocks that have underperformed, possibly going to see a bad reaction. Bharat Forge was something that we were talking about. It's a miss on the estimates and it is reacting in trade. Balaji Mines also a weak Q3. IFL Finance, total income is down 4.4%, PAT is down as much as 92%, and you have it reacting positively. It's not at least a big negative. Natco Pharma, this was the big negative that we talked about. The revenue and PAT are both down quite considerably, and the stock taking a battering. FTC also reacting negatively. You have SH Kelkar, which we've spoken about, and the margins have come at 11.9%. That is a sharp contraction. It is certainly reacting downwards, down as much as 5%. Orchid Pharma, Godavari Power and Landmark Cars, the last set of numbers, all reacting negatively to a disappointment in earnings. So, Neeraj, the takeaway for me is beats or meets in estimates not being rewarded very handsomely, but the disappointments are getting trounced, and how.
Absolutely, Alex. I mean, it's going to be interesting from here on as to how the second part of the day also pans out in terms of markets, because that's going to be crucial. As Srikanth was pointing out as well, 23,000 is the support that we should be watching out for. But if we are able to sustain about that, 23,500 is what we should be looking at. But very interestingly, you have the pharma pack which is holding up. So Cipla, Dr. Reddy's and Sun Pharma, 3 names from Nifty 50 which are trading in the positive from the pharma pack. Very quickly, Aditya, if I come to you on the pharma space, how are you looking at it, taking into consideration the top tier names which are in the positive right now? Earnings have been announced so far, and if you talk about the mid tier companies as well, it's a pretty mixed bag so far. What would your view be?
I'm negative the US generic space. In the US generic space, the pricing pressure is slowly and steadily increasing. Only those companies which will keep on introducing new products are going to win. So, for example, companies like Cipla, where their eye care products are going to hit the market in the next 2 to 3 years, that is a company that you can really look out for. But within the whole pharma space, I am very positive on the CRAM CDMO space, where a lot of companies are getting good order wins. So, for example, companies like Piramal Pharma or companies like Syngene, which has also seen a lot of correction in the stock price. That's where the real juice is, in my opinion. Or you can also look at, for that matter, the diagnostic space, the domestic diagnostic space, with respect to Krishna Diagnostics, or for that matter, Dr. Lal as well, is something that I am really positive on. Not so purely positive on the US generic space.
Okay, very quickly, Aditya, Bharat Forge numbers and left a bit to be desired. We're talking to the management. Disappointing, or you believe there is a ray of hope?
So right now, Bharat Forge is a very big exporter to the US, and we don't know what President Donald Trump is going to really do per se. So right now, I will wait and watch and see the development in the US. Prime Minister Modi has gone there in order to smoothen the talks out and make sure that tariffs are not imposed on India. However, it's a long story, and any company which has exposure to the US, mind you, Bharat Forge has exposure to class 8 trucks in the US. That's where the real problem is for a lot of these companies. So I will wait and watch and avoid these stocks for the time being.
No, others like SKF, Balaji Amines, etc. are also down. Suven is amongst the top gainers. Honasa is the other one. Muthoot, 4.5. So those are a few. Lupin, by the way, we'll just hear from Lupin in moments from now. But Shrikant Chauhan, quick opening thoughts. We got to go to the management of Lupin, but quick opening thoughts from you on the open and anything that stands out from trade.
Yeah, I think it looks a very stable market, and if we see the market is dropping to 23,000 during the day, then there we should look for taking some contra bets. But yes, stock specific activity is definitely there, and based on the option statistics, I am of the view that now the market is going to spend time; it is not going to fall further. So it may be on the high side 23,200, on the downside 23,000, but we will get a lot of opportunities in stocks to trade for. Yes, pharma stocks are doing well, and yes, in that we like Lupin Laboratories.
Gentlemen, both of you, thank you so much for taking the time out and being with us. Really appreciate your time. And now it's rat-a-tat, earnings and more for the next three conversations. Let's first put the spotlight on Lupin. So Lupin is the first one on our radar. The stock is up about 3.5%. Profits jumped almost 40%. Margins expanded. Varsha caught up with Ramesh Swaminathan, ED Global CFO and Head of API Plus at Lupin, talking about the quarter gone by and the road ahead. Listen in.
In a general sense, we've done very well in India also. So there are certain parts of the the business which are not which therapy areas which are under a bit of stress, and I would actually highlight the respiratory portfolio out there. It's not that it's the respiratory therapy at our end alone, which is under some pressure. It's been across other companies as well. The industry as a whole, the therapy area as a whole, did not do very well. This is kind of highlighted by the competition as well. But having said that, people were also a little disappointed with, in fact, the overall volume growth in India. So, and I think there is something to be said about cyclicality and the like as well. So I would think, in a general sense, the pharmaceutical market should be growing at least 50% above the GDP growth rate. There's a lot of lack of awareness and penetration in India, which is still a problem. And I think there is a secular growth story to be had over time here.
So the issues in respiratory segment, when this is expected to bounce back?
There's no reason why it shouldn't be bouncing back, because it's not as though that it's disappeared or something like that. It's clearly there. There are a lot of patients out there with respiratory problems and the like. We are clearly focusing on the right things in terms of coming out of the portfolio, which will benefit the patients out there. There has been, of course, a focus on bringing differentiated products. That are triple drug combination that we brought into the market in India. Is obviously a precursor to things to come for the future as well. And clearly, we are placing our bets on the respiratory portfolio for India and for other parts of the globe as well.
On the US business, wanted to know about your, what's the way ahead? What are the products which are in pipeline, and also the key products which you're going to launch in US, like tolvaptan and injectables, when they can become big for Lupin?
Tolvaptan, we have in fact an exclusivity possibility in our next year, in our early part of next fiscal. Clearly, it's going to be a big molecule for us. So that's one part of the story. And the second is essentially the kind of products that we're bringing on the injectables front. So glucagon, Disperdal Constab, liraglutide, some of the names that kind of suggest themselves at this stage. Clearly, we have a pipeline which will take care of the buoyancy on the top line front for America for some time to come.
So continuing on the US business, can it deliver double-digit growth? Because you had guided a single-digit growth last quarter, if I'm not wrong.
Yes, clearly a possibility. So all of these are pretty good molecules. You've got to wait and see. And of course, there is the currency depreciation, which of course has to play out given the geopolitical tensions and the like as well. So we're pretty optimistic about double-digit growth in America in the quarters to come.
So can US become $1 billion plus in revenue by FY26?
Clearly, I think that's story is on. The generic plus the brands bit clearly will exceed $1 billion in our expectations next year.
Talking about the Europe business, which grew 20% for you, what has driven this growth and how sustainable is this growth?
Yeah, you're speaking about Europe. Europe has been doing pretty well on the back of, in fact, the respiratory portfolio that we built for those markets. And of course, you've got specialty drugs like Namuscla also, which have contributed chipped in. So all of this, if you look at the areas, the geographies, the countries that have done very well, we have Germany, we have, of course, UK has done extremely well. So we expect this growth to continue for sure.
So, considering your US business, then your Europe and also India business, will you do a double-digit growth in the next 2 to 3 years?
I think so. Clearly, the potential is there because the kind of products that we are working on and have brought to market also in recent times, a lot more addictive. The price erosion associated with some of these products, inline products, is much lower. And given the products that they're bringing to the market, I think the top line buoyancy can be kind of sustained across all of these markets for sure.
On R&D part, if you see research and development with respect to sales was about 7.7% versus 8.2% in quarter 2. So are you expecting this to increase in quarter 4?
Yes, there has been a lot of this actually has been pushed off into Q4. So I do expect a substantial increase in terms of R&D spends for the next quarter. But in an absolute sense, I think this is very much on, given the fact that we are kind of pivoted away from vanilla products, OSD products, and spending more on complex injectables, on respiratory products, and the resurgence that we're seeing in terms of interest for biosimilars also. So interchangeability is now on in America. And from that perspective, I think the market is about to take off. So given all of this, I would imagine that the absolute numbers associated with R&D is certainly expected to kind of increase.
So, company's cost optimization has actually helped when it comes to, margin uptrends. In the next 12 months, what kind of margin performance you're expecting?
Clearly, as you very correctly point out, there has been a lot of, success on the cost front, so the tight leash on cost. Apart from the top line buoyancy, the other contributing factor for margins has essentially been, working on the cost front. So every line of the P&L, be it raw materials in terms of alternate vendor development strategies, looking at clean cost sheets, looking at, salvaging your solvent recovery programs, looking at, in fact, make or buy calls when it comes to API and the like as well. And working on further down in terms of productivity of the sales force, or for that matter, the workforce at the factories. So all of this meant, that this focus on costs, was throughout across the entire value chain. So, and clearly even areas like, air freighting, should we not be doing ocean freighting more, the mode of transportation. So, and the write-offs associated sometimes with, with production, inventory. There's been a lot of emphasis on all of this, and clearly the results are there to see. EBITDA margins have crept up. In fact, the overall margins could reflect a much healthier number if you were to knock out the impact of adjacencies, which are still making a loss at this stage. So I would be very happy to state that the emphasis on higher margins is certainly on, and you would see better results coming in the quarters to come.
That's Lupin, a strong number, and the stock duly reacting as well. Now, another one which came out with a decent set of numbers, clocked in a 49% increase in its profitability is PN Gadgil. But margins are flat and the revenues slightly lower. I mean, the revenue growth lower than what was there in the previous quarter. Now, before we speak to Saurabh Vidyadhar, Gadgil, who is the chairman and managing director at PN Gadgil, Mahima Johnson to with a quick synopsis of the quarter. Mahima.
Right. So, festive season has continued to contribute significantly to PN Gadgil's numbers. In terms of the operation metrics, there was increase in transaction count, and average transaction value also saw an uptick. There was increase in footfall, coupled with strong conversion rate, and overall 9-month FY25 same-store sales growth stood at around 25.7%. In terms of financial updates, they repaid around 300 crore term loan and CC. 100% of gold for them is hedged. In terms of numbers, revenue saw an uptick of around 23.5%, net profit was up 49%, EBITDA up 33%, and margins at 5% versus that of 4.7%. In terms of segmental performance, retail segment revenue grew by around 41.8%, e-commerce grew by 98%, and franchisee revenue grew by 87%. In terms of operational highlights, revenue per store stood at 127 odd crore. Footfall saw an uptick of 36 odd percent, and conversion rate was at 93.7%, and studded ratio was at 38.7%. So overall 7.4% of the total revenue is studded jewelry right now. In terms of stores, 9 new stores were added this quarter, and total store count stands at 48, and management has said that it plans to reach 53 stores by Q4 FY25. So this is the overall view of how Q3 panned out for PN Gadgil.
Noted. Thanks, Mahima, for that. Saurabh Vidyadhar Gadgil, as I said, the CMD of the company joins in right now to talk about the quarter. Saurabh, two ways to, a glass, how do you view the quarter? Glass half full or glass half empty? Because it's a good quarter, profit after tax numbers look very solid, festive season has contributed. But when I look at the growth numbers, and correct me if I'm wrong here, of what you did in quarter 2 in terms of growth versus what you've done in quarter 3, the pace of uptick just petered down a little bit.
Good morning. See, rightly said that Q3 is the biggest quarter for the entire jewelry industry, and Q3 sees a huge uptake both in terms of jewelry as well as bullion. What really helped Q2 this year was the dip in import duty cut. So we saw July as a mini Diwali this year. That is why the Q2 numbers were very good in this financial year. But having said that, was Q3 results good? I think I'm more than satisfied considering the high prices, considering the demand which we had foreseen in June, July, and which could have taken a toll on the Diwali demand, but that has not taken place. In fact, the month of October itself, we crossed more than 1,000 crores of revenue, which was the first time in the history of the company. So we are definitely satisfied, pleased with this entire performance. And like you said, all the matrices have shown a positive improvement, and we have been able to attract more footfalls. Our number of convergence ratio has remained constant in spite of the high gold prices, and that has reinforced the faith of the consumers in the company and in its jewelry designs.
Okay, Saurabh, the question therefore would be that what lies ahead now. I remember at the end of or the beginning of the festive season, everybody mentioned about how this period until May is likely to be the period with the highest wedding dates, and therefore business for jewelry companies will look rock solid, etc. Is it turning out that way? Are you sensing that in quarter 4 as well, and could it translate into better revenues even in quarter 1 FY26?
Q4 is typically a quarter when you have the wedding season going on. So Jan, Feb, and a part of March will have weddings, which will add big ticket items to the sale booty. Along with that, this year also in Maharashtra, Gudi Padwa is falling in March, so that's going to be a big shopping day. And coupled with the bullishness in the gold prices, where consumers are looking at entering the gold market right now, I think Q4 should be a good quarter. We are not seeing any major concerns on that front. Diamond sales have been strong even in Q4, and as we have seen that the studded mix at our company is showing a very healthy increase. Our Polki jewelry segment, which we launched in Q2, has really showing signs of good sales, and that's another category which we are very bullish on, because that's going to be a category which will really enable us to take the studded ratio, as we had said, more to upwards of 10-11%.
Okay, so studded is something which you're betting big on, but do you think, is there any possibility of the man-made diamonds to come in and restrict your play in the studded segment? I know it's a bigger stone when you talk about man-made diamonds, but what is your exposure, and how are you, are you planning to probably even introduce this kind of a category then?
See, firstly, there's been no demand from consumers for lab-grown diamonds at any of our stores. So people primarily who come to us are serious jewelry shoppers, who are value shoppers, and who look at jewelry also as an investment. So that really has not been an area which we have seen demand on. Secondly, most of the jewelry chains which sell diamond jewelry are selling diamonds which are in the size of less than 10 11 cents. So this is not a category which really lab-grown has taken on. Sizes which are like 30, 40 pointers above and solitaires is where lab-growns could make a price impact in terms of the price differential. So we don't see any real impact on lab-grown diamonds affecting our diamond sales. In fact, we have seen positive growth and steady growth in a natural diamond category, and we'll continue to focus on that.
Okay. And overall, with regards to your revenue per store, on an average, I think from 100 odd crores, you've gone up to around 127. What's that trajectory looking like going ahead, and what's the translation that you will see in terms of the top line? Because we're talking about a 23% growth this quarter. As Neeraj pointed out, Q3 was stronger. So what is that number for FY25, and how are you going to enter FY26?
As of now, we're just in the middle of February, so it's very difficult to comment on the entire numbers. But I think we'll be close to the target which we had, mentioned that around 7,500 to 8,000 would be the top line for the financial year ended 2025. Secondly, like you mentioned, the sales per store has seen an uptake. There have been two reasons for it. Primarily, we have seen same store growth of more than 26%. So that has been one factor where we have seen even growth in volumes. And second has been also the increase in prices post July. So that has also aided the same store growth and also aided the revenue per store. But as a company, we really thrive on this model of not going very aggressive on big store sizes. So that has helped us to keep a healthy revenue per store, and also a very, very positive and a healthy revenue per square feet, which is upward of 6 lakh rupees a square feet at our company.
I wonder what is the outlook with regards to costs and liquidity. The RBI has done enough to ease that, so that shouldn't be a problem. But are costs moving up for you, and will you be able to therefore manage this uptick in margins that you've shown in Q3, or is it difficult to call that?
See, costs have not seen a significant surge. If you look at our expansion, primary was in Q3 when we launched 9 stores in the month of Navratri. So that has added to the HR cost and to the direct cost. But beyond that, the costs have not seen any significant surge. Our finance costs have gone down because we have repaid almost all our debt. Today we are 100% hedged, so that has really helped us to keep the cost in control and also to be risk averse. So I don't see any real threat in terms of cost increase in Q4.
Okay, Saurabh, 53 number is what you have in mind in terms of store count by the fourth quarter of FY25. Are you on track to achieve that, and if so, any additional capex that you will require?
Sort of 53, we already done 2 stores in January, so we're already at 50 right now. 3 more stores are being planned in the month of March, which are already almost to nearing completion. So 53 is a number which definitely is achievable, which will be done by us. So in terms of capex also, it has already been absorbed. So there isn't any further surprises on this front.
Right. So no surprises in terms of store openings as well. Thank you, Saurabh, so much for joining us on the show and sharing the outlook going ahead. Let's just quickly pull up the counter. No major moves coming in terms of PN Gadgil. And if you see in terms of the price to earnings as well, I think it's the third most expensive from the top 3 or 4. So you have Titan, which is almost trading at 88 times. Kalyan Jewellers, which is closer to that, around 79 to 80 times. And the PN Gadgil at around 36, 37 times. So the cheapest of the top 3, I would say, Neeraj, but the stock is seeing gains now of around 2.7% as we speak. But moving on, you have a Bharat Forge that is in focus in today's session. 3% downtick coming in on the counter. If you see in terms of the revenues, a dip of around 10 to 11% on that one. Margins have also seen a contraction this time around, and the profit number is down around 16 to 17%. What's interesting to note over here in terms of Bharat Forge is that there has been a slight bit of softness in the CV demand. The European operations were weak, and the defense revenue has been lower as well, and I think that's what the street is actually taking negatively. The other aspect, Neeraj, is the order win momentum. That has also decelerated in the third quarter. So 800 crores is what you've seen in the third quarter versus a 1200 crores in the second quarter. In fact, let's get in Amit Kalyani, Vice Chairman and Joint Managing Director at Bharat Forge. Amit, good morning, I beg your pardon, and welcome to the show. In terms of the numbers internally, have they met your internal expectations? Because clearly the street is not looking at it that positively, taking the downtick that we are seeing.
So there are two parts to our numbers. The in automotive numbers, I think, were a little lower than what we would have expected, also because of the cyclicality and overall softness in some of our end markets. I think the industrial numbers, which was our acquisition of JSA and the ramp up of that, was pretty satisfactory, and in fact is starting to do well and will continue growing quite fast. On the defense side, as we've always mentioned, the defense business is one that you should look at on a year-to-year basis, the full year basis. It's not a quarter-to-quarter business. Also, the point you mentioned about order intake, this is the quarter where everybody has year-ends happening. So in the year-end quarter, typically no major decisions on sourcing, etc. are done. Also, there are inventory corrections that happen at everybody's ends. Notwithstanding all that, I think we are fairly sanguine, and we are very, let's say, clear about what we need to do, as we've mentioned in the analyst update as well, that this year will be flattish on the market side, but we expect to see growth coming from our industrial sector, coming from some of the new products that we are launching, and also our defense business will continue growing.
Okay. Amit, good morning. Neeraj here.
Hi, Neeraj.
And just love to understand, I'll have a few questions on announcements, more importantly than just the numbers too. But a follow-up here, if FY25 turns out to be a flattish year, are you more constructive about what could happen in FY26? One, because of a base effect. Two, because business clarity might just come in. Trump presidencies just begin. Maybe clients will take some time to make decisions. Maybe February or March is that month. The CV cycle seems to be looking okay. Maybe in the US too, it might look okay. Just trying to understand how you gauge the slightly longer term picture.
Yeah, you're absolutely right, Neeraj. The CV cycle, first, let's talk about it. It's clear that the Indian economy has to start growing at a faster pace. And as and when that happens and the signs of that start being seen, you will see the CV sector grow quite rapidly. Typically, the multiplier is anywhere between 1.5 to 1.75 of the GDP growth. Sometimes it can be even higher depending on the age of the fleet. Secondly, in the US, the whole talk of Rebuild America, setting up and increasing the power capacity, power generation capacity, rebuilding a lot of the infrastructure that has become old, as I have mentioned before, is all very, very conducive and directly having an impact on the construction and transportation sector. So those are sectors that we have a lot of business in, and that should see growth. Plus, there is emission norms changing in 27. Now, again, emission norms and what happens with them remain to be seen with the new government, but otherwise that would have meant that in 26 there would be a pre-buy.
Okay, fair call. Now, the question that I would have is that I'm just on results, one more question, Amit, and that is around the cost of raw material. Now, it's a bit unclear as of now to us sitting out here, because China is doing its bit. At the same time, don't quite know how much of a stimulus does it give and what resultant impact it has on commodity prices by and large. And supply chains, I believe the issues would have gotten sorted by and large. But again, don't have a clear handle there. Any thoughts on both of those?
Commodity prices also will be impacted by, political decisions. Right now, commodity prices are softening because of overall demand going down, and the European economy is being a little slower and cooler than others. But again, I think we have to wait and watch. But I think, fundamentally, commodity prices going up for the company directly, we have a pass through. So it doesn't impact us directly.
Okay, Amit, now a few announcements or a few points. I mean, some people have picked it up people picked up hints as I read of restructuring at overseas subsidiaries on the con call. Now, I don't know if you actually explicitly said that, or did you actually give a hint, or people just picked it up, but would just love to know, how are you thinking about that
look,
piece?
It's very clear, there is a fundamental shift in the overall, manufacturing, let's say, ecosystem and manufacturing requirements in Europe. We are seeing, major customers also cutting down capacities. Many customers are also restructuring their own plans of what they want to make, what they don't want to make. So what we have said is that, we are not happy with the performance of our subsidiaries in Europe. And we are going to take 6 months to decide, after talking to all our customers, what is our strategy going forward. Within 6 months, we'll have a concrete plan, which we will then elaborate and obviously implement.
So Amit, a follow-up on that one is, if you're going to review the manufacturing part of it in the overseas business, yes, the weakness in Europe, the demand slowdown probably in North America, how is it going to impact your financials? What are you penciling in right now?
So look, yes, as we mentioned on the investor call, I don't think the impact is going to be worse than what we've had this quarter. And secondly, please remember that at least we have a global footprint, and we have strength of balance sheet and wherewithal to manage this, and also work on reducing costs and improve the performance of our subsidiaries, no matter what. We have a lot of European manufacturing that cannot operate profitably below, 80-85% of capacity utilization, because their break-even levels are high, their structural costs are high, and there's clearly going to be opportunity to move business from other geographies into India. For a long time, it was China, then it became Vietnam. I think it's now India's turn. India and Indian manufacturing is, becoming evident, the advantages of that. And I think that there is opportunities in the medium to longer term to substantially accelerate the growth of our business out of India.
Okay, just wondering, Amit, a follow-up on there. Would it need some aid from the central and state governments, or would you believe now businesses would be primed to bag that share that you spoke about?
See, I think the help that you need is policy and policy implementation in a time-bound manner. And second, if there are strategic sectors that the government wants private sector to get into, there needs to be a long-term approach, and sometimes there needs to be hand-holding. I mean, if you look at the semiconductor sector, the battery sector, clearly those are sectors which are critical to India, and the government has had to, provide a structural solution to make them competitive. But those are very long gestation businesses. We are not talking about anything like that. We're talking about businesses where, once you invest, within 3 years, you start generating, returns, but sometimes even 2 years. One of the points, I don't know if you captured, was that we are investing in new capacities to make new products for aerospace. And this will be a significant growth driver for our aerospace business. And we believe that with the customer tie-ups we have and the overall growth of the aerospace industry, and especially the demand growth coming from India and Asia, the supply chain and the value chain also has to move into this part of the world. So we've had 2 large announcements on aerospace, one on defense, And I think those are all going to be massive growth drivers. And for example, the landing gear line, we are increasing our capacity and doing more value addition for products that we're already supplying. So it's moving from one stage to significantly higher value add.
Got it. Actually,
aerospace, as I mentioned on the call, is that we expect to see our quarterly numbers cross, 100 crores this year and grow substantially from there. So we expect to see, 30, 40, 50% growth YOY in this business from FY 25-26.
Yeah, it's going to be my next question. The partnership with, I believe you pronounce it as what, Liebherr? Liebherr. Okay, yeah. So I was going to ask you about that as well because it's standing out there. So, yeah, can you talk a bit about that? Is that
so this
a
is
part of this
company
thing?
Which we have been working with for quite some time. It's a, family-owned European company, very strong, very long history, and great set of products and sectors that they operate in. One of which is aerospace, and they clearly see that for the single-aisle aircraft, the volumes are growing to a point where it has to move from, one at a time kind of manufacturing to a significantly accelerated manufacturing process, because volumes are significantly growing, and especially Airbus has grown its single-aisle volume very, very dramatically. And especially the orders that they have also received in India. So the future demand for these products is also going to be here.
Right. So that's with regards to the demand on the current products. But Amit, in terms of the defense portfolio, from what I read was that you've gone ahead and lowered your guidance with regards to the top line expectation versus a revenue expectation of around 50% in FY25. Correct me if I'm wrong, and this is the group defense business. What is the outlook looking like, number one? And two, what is the executionable order book that you're sitting on?
Second question, our executable order book currently without ATAGS is about close to 5,700 crores. One of the things in the defense business is that the business doesn't go away. It just takes a little more time. So what we had thought will happen in Q3 and Q4 will spill over into a little bit of next year. But, I don't think the business is going anywhere. It's just delays in orders coming in. We have a lot of new products that we're also launching, and we will announce at IDEX significant new exciting programs. So, in defense, what you're saying technically is right. It's not so much a guidance reduction as in, the execution being, let's say the order intake on the whole processing moving from one quarter to another. But once the orders come in, we are able to accelerate deliveries as we have shown in the past, because we have a fairly large capacity. So, as soon as we get our orders, we can start implementing them very quickly.
And very quickly on the ATAG orders that you have, and I think your L1, what is the potential timeline that you're looking at in terms of the contract to be signed and in terms of it actually reflecting on your revenues? What's the execution timeline for that?
So look, the order signing is expected by everyone to happen in this financial year, which means before March. March, maybe it'll spill over into April, but the process is that once we get the order signed, within 6 months we will have our FOPM done. Then you have some validation, and then within a year you can start deliveries. And I think we have a fairly significant ramp up of delivery that we can do. I just read a point on the ticker which said that a lot of our European arms cannot operate below 80 to 85% utilization. That wasn't what I meant. What I meant was that most supply companies which are in the sectors like ours, which are in forging, casting, etc., small and medium companies cannot typically operate profitably below 80-85% capacity utilization because of high break-even levels.
Amit, thanks for pointing that out. We'll get that changed as well. I have one last question, Amit, before we thank you. A brokerage house which is looked at your numbers slightly not as sanguinely is saying that the European woes have driven the Q3 miss and the outlook not looking good as yet. A house which is looking at you slightly more convincingly saying that they are bullish on the uptick in the US Class 8 cycle coupled with strong growth in the non-auto business verticals. You personally, are you in the near term, long term we know it's very constructive, in the near term, what is the bias towards? Strong growth in non-auto and Class 8 truck sales, or Europe has a bit of an issue which you need to resolve first?
So I think the Class 8 and the non-auto will grow very fast. And Europe, the jury is out. I think Europe needs to get through its elections and then chart the direction that they're going into. But notwithstanding that, I think, Neeraj, what we have said on Europe is give us 6 months and we will have a concrete decision. The bottom line is that we will fix this business once and for all.
Once and for all.
Either way. So I think that I would tend to be more, I would say, bullish rather than bearish.
Well noted. Well, looking forward to more conversations. Amit Kalyani, thank you so much for taking the time out and speaking with us.
Thanks, Neeraj. Take care. Bye-bye.
That's Bharat Forge for you. More constructive. And while this the stock is down about 3%, it's off the lows of the day. We'll need to slip into a break, but keep in mind, a quick reminder, NDTV Profit is holding its first ever conclave on February 18th in Mumbai. Excited to be in conversation with stalwarts of the markets, giants of India Inc. and policymakers steering the nation from how the Indian consumers' habits and behavior has changed with the rise of quick commerce to how to make India the manufacturing hub of the world. Gritty entrepreneurs from a brave new generation open up and give us their invaluable insights. We are excited to host the conclave, the blueprint for Viksit Bharat 2047. It will be live on NDTV Profit, and if you can make it to the conclave, please do register.
Tax regime for individual. In fact, there has been discussion on how to sort of reduce the tax rate.
I am now happy to announce that there will be no income tax payable up.
Welcome back. You're watching India Market Open. If you see in terms of Bank Nifty as well, 240 points up move is what we are continuing to see. Nifty 50 as well at the, we can't say at the day's high, but at least in terms of opening highs, that's where it continues to stay. So it's going to be an interesting day of trade in today's session. And if we sustain above these levels, there could be a trend reversal that could sustain from here on as well. But quickly, let's welcome in Ajay Srivastav, Managing Director at Dimensions Consulting. Ajay, good morning and welcome to the show. The kind of route that we've already seen, specifically with regards to where the broader markets go, the corrections that have come in, do you think it's the end of this route and probably there is some green light that could be emerging from here on?
Good morning. I think, the answer is, to your answer is, I think we are in oversold territory at this point of time. Having said that, I think we need to be cognizant of the fact that a lot of companies did not give results in line with the expectations. So how they do the work for the next quarter is going to be very important for us. And the fact remains that this time around, as the March ending comes in the next 45 days, there will be a lot of rebalancing on the side of tax as well, liabilities. People who book profits may want to sell out the shares with their losses to balance their tax, etc. So it's going to be volatile the next 45 days. Definitely it's going to be. But I think definitely on the side that selling is kind of abating, at least in a small and mid cap was a local selling. It's not, you can't say FIIs was selling mid caps and small caps. That's not true. So there was serious profit booking happening in the system. Having said that, if I were sitting on a portfolio, would I sell now? The answer is broadly no, unless something really bad happens to your company. Would I buy seriously? The answer is perhaps again no, because, that's it, 45 days, volatility, RBI out of ammunition, Trump where he is today. I think this is going to be a time where you wait patiently for times to come and you buy. But I think market bottom, perhaps for the short term, definitely yes. So you don't need to sell if you're really worried about, in our view, about that more damage can happen to your portfolio.
Ajay, good morning, or should I say the globe-trotting Ajay Srivastav with us finally after repeated requests.
No, I just tell you something which I want to repeat to all my viewers is, it's a very good idea to keep in cashing your money and using it for the things that you like to do in your life. Believe me. Yeah. And today when we are a lot poorer, we will remember that, oh my God, look at our profits in October.
Okay, fair call. So you use the money wisely, I must say. Okay, great, Ajay. But good to know that you are saying that this is not the time to sell, even if this may not be the time to buy now. And I agree completely, Ajay. So my question to you is, what would it take for you to become constructive again? Would it have to be corporate results and commentary following, or would you preempt that via some lead indicators, political actions, data, or otherwise?
See, you summarized very well 4 points of decision making. And I think very clearly the reason we are not buying seriously at this stage is because I think the RBI has run out of ammunition. If you see what's happening in their market at the point in time, look at the financial market, look at interest rates, it just all went awry. Political signaling costed the country very heavily because the interest rate went wasted. You have one bullet or one interest rate. You need to make it happen. You need to make it the mark. You just wasted the bullet. Now the is gone. Interest reduction is gone. There's nothing to show for it. There's nothing you can do about it. And US very clearly last night, if you heard the Powell testimony, said, we are not in a hurry to reduce interest rates. You have brought the country's interest rate perilously narrow the margin to US interest rate, and we are all paying the price for it in terms of the push for FIIs to get out of Indian debt at this point of time. Forget equity. Debt was also could have compensated. If you run contrary to the global policies, I think you will pay the price, and we are paying the price. Not that the rupee got stabilized, but we lost all the traction. We lost all the FI debt. So, one of the reasons is, could RBI change track? Could RBI become more independent of its assessment in tune with the US Fed policy? That could bring you back to the table because that makes people comfortable to put money in a country. Until FI buying doesn't come back, our buying lot will not improve because retail has done its bit, SIPs have done it, MF have done it at the bit now. You will see in the next 12 months more profit booking happening as market moves up. And that will be the challenge for the market, that every time it moves up 10% odd, you will see huge amount of selling as people will sell. So critically speaking, we need to get FIs back if the game in the stock market needs to go back. Otherwise, just on domestic legs, I think we have done with what we could do. And that's where there's political action, PSU divestment is off the agenda, your budget is gone, tax cut has already been absorbed by the market with no difference. That's why I said the ammunition you had has been now wasted and gone. So I'm not sure unless there is what's happening in America, unless you change the dynamics of the country, you talk away and say become merit-oriented, focus on privatizing PSUs, nothing going to happen to the economy to make you buy.
Ajay, I have a question, Ajay. I mean, 25 basis points at the margin wouldn't make the foreign institutional investor come back any which is, right? So my question to you is this. So I take your point. I take on board your point. My question is this though. What causes the FI to come back, right? Is it an EM dedicated sell-off which India is a casualty of as well? And will FIs come back with the reportage of earnings, or will it be a policy decision that will make FIs come back?
Yeah, I think it's going to be I don't know whether will come first, the horse or cart, but I guess it's going to be a combination to say I have comfort in the policy making that it is in tune with what's happening globally. It's just not dictated by local political requirements of headlining. I think that's the most important part out here. You got to be in sync with US Fed. If US Fed is saying that I cannot reduce my interest rates anymore, at least that's what the testimony was given the inflation rate in the US, and your margin is narrowed down to less than 2%. Where is the room to get interest rate down? You have a very negatively hawkish RBI monetary policy committee at this point of time, bent on reducing interest rates. Now, if you were looking from outside, you would say, hello, America is not reducing, your policy committee is bent on reducing. So signaling is equally important. And if that doesn't happen, today what's happening? Banks don't have money, demand is what it is, it. So what does trigger it off at the end of the day? Someone needs to put money in the system for the system to go to the next level energy. How do you shift gears? The gears will be shifted by the FI buying at this point of time. And they need to see both apart from the results. Results partly is better off because your now P ratios are so much more lower that your comfort that things may improve is much higher for any investor at this point of time. But the fiscal and the monetary signaling is going to strengthen and says, okay, guys, we are on the right track. Results will catch up eventually. Ps are down. Time to go buy in. And that time to go buy in is going to change the fortune of this market from outside this country, not domestically.
Ajay, one question I have with regards to FIs coming back is, barring IT, FIs are much more engaged with regards to the consumption story right now in India, right? Now, for them to come back, how important is it for the global sentiment to improve? Because clearly they're trading micro as opposed to the global macro so far. So how would you respond to that?
What is global? Global is America. Global is Japan. That's it. Two countries and a little bit of China at this point of time, but China's story is not the flavor of the day. Global is America. Europe is retired and gone out of the systems. Nobody talks of Europe. Nobody invests in Europe. Nobody thinks of Europe. So really, that's why I said you need to be in sync with what's happening in the US. And when you said US market, if you saw the inflation data in the US, the inflation is going up and not coming down. The unemployment rate is one of the lowest historical ever. So, macro-wise, you have a very strong US economy. The rest of the economies are weak. You have a weak Indian economy at this point of time, comparatively. So you got to bridge the gap. So I'm not convinced partly that we have a macro problem because America is life and humming at this point of time. The rest of the world is having a problem, but that's all about it. But so, Japan is doing reasonably okay. You saw what's happening in Japan. The interest rates are now back from zero at this point of time. Ignore Europe for time being. China, I think we hit the bottom at this point of time, and they are formidable. I can tell you something. We talk about being a manufacturing powerhouse. People need to actually see what's happening in China to understand it's not going to be a cakewalk for India to be a powerhouse. What they're doing is amazing. So my guess is, again, back to the same point. It's not macro. It's the micro issues we need to tackle in India, become productive, focus on this, and get out of freebies. Look at where OROP, pensions, if you saw the Indian budget, there is no money left to invest. OROP charges, pension charges, salary of PSUs and employees of government put together, interest payment. What is discretionary left with the government of India? And I think that's where I said when I alluded to say, we need to do a Musk in India, we need to do a Trump in India. Cut the hell out of the flab of India, put the money back in the market, develop our cities well like what China has done, and privatize the PSUs. If that doesn't happen, short-term case of investment thesis is just at this point of time in a doldrum.
So Ajay, once you start looking at putting money into the market, once the rout is over, maybe 2 months, 2 quarters, whatever the timeline be, where will you start putting your money?
I think if you're already there, pharma is a safe bet with rupee dollar where it is. 50% of revenues come from, or 60% revenues come from America for most pharma companies. They will make quite a handful of gain at this point of time. And you can't replace a pharma medicine chain so easily. You can't replace a CDMO so easily. And at this point of time. So therefore, and also CDMOs in India, partly because they're sitting on huge capacities which they're not able to fill. So everybody's got capacities, everybody's done the investment. So I think pharma, CDMO sector should do well in the next 12 to 18 months at this point of time, definitely. I think hotels, aviation continues to do well at this point of time. The demand is good. There are no new suppliers. We saw telecom story is emerging as very beautifully. A telecom story is emerging out of there. I think at this point of time, the engineering exports to America is good. Engineering exports to Europe is in doldrum. All the companies are down at the bottom. They might recover a little bit. So if you were to do the hierarchy of things, stay with hotels, stay with aviation. Pharma is good at this point of time. And telecom is a wonderful story. And, on and on, you get good quality companies in the what is called new age space. They gave you time to buy again. If you've not bought your portfolio, you can rebuild the portfolio with new age companies. But as I keep saying, 30 to 40, maybe 50% of your portfolio should be companies which have come of age in the last 3 to 5 years. That should be the mantra for the portfolio more than sectors. Go for the new hungry guys than the old fuddy-duddies. And you saw what happened to all our FMCG consumers. They're dying by the hour.
Yeah, that is. Ajay, I'm tempted to ask this to you. Where within because small caps are suddenly the new hated lot in town. Not everything will be bad. Where within the small cap universe are you constructive and why?
See, the small cap universe, I don't know. First of all, definition of small cap is also so wide. It's 1,000 crore, 500 crore. What is the small cap in this country? But let's assume that you've got turnover of...
But no, beyond 250, Nifty 250, let's say. Let's stick to the definitions.
See, beyond Nifty 250, I think number one priority to us has been we're buying the hotel companies because they will be sold. And they've got tremendous value at this point of time. Hotels is number one in the below 250 category that we're seeing. Number two is consumer brands. Because the new age consumer brands, that's what we are buying because they will be bought. You saw what Hindustan Lever did just now. Nestle is trying to do it. Everybody's trying to hustle into the nature's pack. And therefore, all the brands which sit there in the space will have a very wide traction. That's the second lot of the companies, which we think is a great thing. The third lot of companies, in our view, is going to be the EPC companies, which will see a lot of traction at this point of time because the big guys are finding it challenging. The smaller ones are doing better. So I think in that space, this EPC could become the next big thing. So I would still go for, as I said, hotels is a priority one at this point of time. The consumer brands, priority two. The third is EPC, and the fourth would be the smaller pharma companies. Because beauty of pharma companies is you have a 500 crore company, it becomes beautiful to buy by all the PE funds and to add on. So they give you tremendous value in the end, even if not on the share price, on the buyout mode. So look at these four sectors, and I think you should be fine with it one. Local defense companies, which were flavor of the day, I think verdict is out, how much orders will come from the government. So it's like another PSU. They'll get orders, they'll do fantastically well for the quarter. They don't get orders, they won't do well. And you saw what happened to the railway company, same story. Built up the hype, no orders, price collapse. So selectively, but I think there are decent cases of below 500 crore companies as well in the market. It's not zero ever.
Not zero ever. But a very interesting conversation today, Ajay Srivastava. Many thanks for your time. I really appreciate it.
Thank you very much. Thank you very much, and you have a good day.
Yep, thank you. A very important point mentioned there that amongst other things that you do, please don't forget to enjoy your money. I think it's important to do that as well. But
I think for that you have to watch a show that Alex does every day as well, on a weekly show that he does as to how to enjoy your money.
Yeah, well, maybe that too. But I think it's very important during these times, and which is why we made it a practice that the last 2 or 3 days we've tried to get you some of the biggest voices in the market to try and tell you how is it that they are thinking while all this scare around what could happen to mid caps and small caps continue. Now, Sandeep Tandon of Quant MF, as large as they come on the local, or actually now in terms of overall money managers who invest in India, and for Sandeep Tandon to go out 2 or 3 days ago and say that we are buying small caps was a big testament of how he thinks about the market and around the pocket, which is currently, unfortunately, the most hated. Sandeep, I don't know if you can hear me, but if you can, good morning, and thank you so much for taking the time out. Okay, I don't think he can hear me. We'll just try and patch this line. But I'll tell you what, amongst other things, what we are going to invoke in this conversation with Sandeep Tandon. Okay, I'm told he can hear me. We are going to ask him what is his current view around the markets, of course, and around the most hated pocket per se, which is the mid cap and the small cap. And Sandeep, can you hear me?
2 seconds.
No, I don't think he can hear me. Let's try and patch this line clearly. Guys, let's take a moment. Let's get the line clear and then go to him. But the key thing is this, whether he's buying the large caps, mid caps, small caps at the current juncture. The other very interesting piece that I liked about what Sandeep Tandon usually thinks about, right? When people say that, oh, India is very expensive, right? The question to be asked is, when was India cheap? And can India continue to remain expensive? I think that is the other very important thing that you could bring forth when essentially you talk to somebody who manages such large oodles of money. And what is it that he likes? I presume he also, much like what Rajesh Srivastava said, hotels is a sector that he probably likes a lot. And therefore, I mean, not to get into minutiae, but I think a lot of those things will be brought out in this conversation as well. The other key thing is that does he have a view around when do or what does it take to get in the foreign institutional investor back into the Indian markets? Because Indian investors, retail, mutual funds, probably the plank on which the market is standing. But for the market to flourish, maybe, just maybe, we need all forms of investors to be investing. I'm told he can finally hear me now. Let me try my luck. Sandeep, good morning. Can you hear me?
Yeah, I can hear you.
Okay, Sandeep, great having you. Thank you so much for taking the time out. Important to have you today. Also because at this point of time when the market, certain quarters of the market are a bit scared around what could be happening to the broader end of the spectrum. Now, correct me if I'm wrong, but you went out and said in this scenario that you are going out and buying small caps. I would love to understand from you how you think of the texture of the market currently.
See, Neeraj, you recollect, we were very early in July 2024 itself, and none of the economists were downgrading India. We talked about the macro data has deteriorated, whatever predictive analytic thesis we have built, and we talked about that something is deteriorating, and it's a mild risk of environment for us, and that's the reason we turned cautious in July 2024 itself. And been since then we talked about that we have moved from mid and small to large and mega large cap. We have moved from illiquid to liquid and from high beta to low beta. That was a strategy. Now you come to September, October 2024 when the unknown risk hit us with the China stimulus thing, and money shifted big time towards China. Okay, because ultimately we're part of same emerging market basket. Okay, and then the mild risk of becomes slightly a major risk of sort of thing. Now let's look at we have corrected for nearly, when I'm talking about not the market correction, I'm in terms of risk appetite data points of view or some of the macro data we look at, it has deteriorating or corrected a lot from last 9 months. I think as per our understanding of risk metrics, we think we have covered 60% of the journey. Okay. Now, nobody has bought virtually at the top of the cycle and nobody has sold at virtually at the bottom of the cycle. Okay. So what we are looking at that this time has come where most admired territory stocks are now trading in neglected zone. Multiple stocks in large caps are in neglected and, neglect sort of phase is there. I think some of these names have bottomed out, which means selective buying opportunity is definitely there in the large caps in particular. And now in last few weeks, the way small and mid has butchered, I think we are still remain cautious on the mid cap space because they're still very expensive. And if I have to say the number of quantities also right from Nifty 100 to 250, so only 150 stocks. So there's scarcity premium which was there in the past. I think that needs more correction. But I made a statement on small cap. Yes, we are buyer in small cap because we think
many names have now trading in the neglected zone. So selectively I'm buying. See, I will not able to, as an institution, the size which we buy, we will not able to participate virtually at the bottom of the cycle. So if we believe that 60% of journey is largely over, and I still expect that maybe end of March, beginning or mid of April sort of thing, this cycle of risk of which is playing out should peak out, which means select buying opportunity has come, and this is exactly what we are doing, because if you recollect, we were sitting around 20% cash few months back. So it's a great opportunity for us to deploy money, and this is something what we are doing very selectively.
Hi, Alex joining in. I'm looking at the fact sheet for the February, the most latest data point that you've shared, and I'm specifically looking at the small cap fund, because really that is the main subject of conversation today. And I see, as you've pointed out, cash levels have come down. It's 6% odd in the small cap fund. As a percentage of the whole, small caps accounting for just about 65%, which is the regulatory limit. Part of that, I'm assuming, is because of the kind of drawdowns you've seen. But how does that change? If you are buying selectively, in your estimation, does that share change materially in this month onwards, or will it take a few months for that to go back up?
See, if you understand, selling from or shifting from mid and small to large takes time. And other way is very easy. So it took, let's say, 7 months to unwind from mid and small towards large or mega large. And shifting from large to, let's say, small cap is a week, 10 days process. Okay, maybe a month's maximum. But as you rightly understood, that we have been running in a very cautious approach. We were one of the few fund house, okay, who were virtually running small cap at closer to 65% only, which is that the limit. Okay, so it give you a perspective that our cautious approach, which we had, and not now, it has been there from last many months. Within the small cap, people used to make fun of us. Within the small cap, we used to own large cap stocks. And that is the based on the environment which we play. In the past, we were running 99.9% small cap. For last many months, we are running 65% only, which is bare minimum threshold required by the SID. So going forward, yes, we have deploying money in the market, but if you expect that next month fact sheet, you will see a reversal of that, is not going to happen, because it's a gradual process. Because I said that we have covered the 60% of the journey of risk of environment. 40% journey is still pending, and hence select buying opportunity is visible, and which we are doing. So we are flipping also some of the stocks, and where we see better opportunity somewhere else. And we are also buying some of the names where we think we are getting at our price or attractive valuation. We are adding those names.
Sandeep, markets or stocks would follow earnings, right? I'm trying to understand, when you look at the next 12 months out, do you believe for the broader end of the spectrum, and I'm not just saying small caps. I don't want this interview to be only about small caps, but that is the talking point because of what one of your peers had to say some time back, right? 3-4 days back. So my question to you is this: do you reckon that earnings growth can bounce back market wide in the next 12 months because of all the impetus, etc. it is coming? Or is this more a valuation exercise that you will execute over the course of the next month and a half, that itna neglected hai, then let's go out and buy it because isse zyada kya bura hoga?
No, Neeraj, we don't look at just valuation. I always say, we are relative framework, valuation analytics only 1/3. Okay, so 1/3 weightage is given to valuation and 2/3 are risk appetite and liquidity analytics, because those two components of macro data is equally important for us. Now, we strongly believe that market is always ahead, like how we spotted in July that something has changed or something is deteriorating. Okay, so we spotted it much earlier. I think similarly, I believe market is at least 1 or 2 quarters ahead. Generally, I see 2 quarters ahead in terms of if market believes that, let's say our cycle is bottoming out. Let's say a lot of people anticipate the March quarter will be the worst and then things will start improving. Then market will be ahead of that. If market believes that its cycle bottom out in July, then market will be 1 quarter at least ahead in making that call. So without getting into very subjective discussion, the way I'm point out, not for the broader market, it is also applicable for certain stocks in certain sector. I think 2025 is all about not even sector, it's about certain stocks. So wherever we are getting that perspective that earning cycle worst is behind or is nearby, I think those are the areas we will take call. If we think that consumption cycle has bottomed out and the budget will give a lot of stimulus, we were early to spot that, and we still believe that consumption as a theme should do very well. India centric, giving the background which we have, where we have worry about the dollar index and the currency front. Right from August, September, we have been showcasing how DXY is the perceived risk in the market, and now it has become a known risk and still not over. Okay, in the beginning of the year, on multiple channels, I talked about this year we should focus on currency market and yield, global yields and global currency market. That will give you better clue for equity market rather than looking something else. With that background, the way I look at the market is that yes, the way you have buying opportunity selectively is emerging in the large cap in a big way, mega large cap also. Similarly, I see opportunity has started emerging in the small cap also. So wherever you see earning visibility is there, or where you believe that if your data or parameter is showing that earning cycle should bottom out in 1 quarter or 2, then I think one should look for buying opportunity, not only from a valuation perspective, but also look at the under ownership situation, the hated zone it has been there, whether liquidity has completely declined, the impact cost has risen significantly. So multiple data points which you look at and then try to combine and see. So we don't look at just one data point and say just, only valuation cycle has bottomed out or peaked out.
Sandeep, this is Hiral on this side. So clearly what you're saying is that you're expecting a risk-on environment. Does this mean, one, you're selecting high beta small cap stocks in terms of your investments at the current juncture? And number two, when you speak about the FI cycle as well, now FIs are almost holding 16 to 17% in terms of small caps and mid caps, and they were the ones who were selling the large caps. I think their ownership right now is in that 6 to 7% kind of a bracket. Once they start to come in as well, are you going to see buying that would come in terms of the large caps? And if that happens, why would you say that you still buy the broader markets, and probably the exposure with regards to large caps could be on the sidelines for the time being?
No, the way I've said that, we are not saying it's an aggressive risk-on environment. We talked about a mild risk-on environment. So very clearly articulate some mild risk-on, because, and as I said that maybe by end of March or beginning April sort of thing, we believe this risk-off cycle which is going on, we started in July 2024, ideally should peak out. Again, as a house, we will take a call as and when data points suggest. As of now, mathematically, this is what we can extrapolate and tell you. This is the way we believe the probability is there. But again, no hard and fast rule of exact timeline. As and when it happens, we will reassess and then take conscious call on that. Now, as far as FIIS is concerned, I think the way FIIS looks at the market is more for their biggest worry is currency market. And if vulnerability on currencies is still there, which is the narrative or noise which is there related to Trump tariff, I think not only emerging market, even developed market currencies are slightly more volatile. And that trend we spotted in September 2024 when we talked about DXY rallying. And it's not only emerging market, rupee has become weak. It's the most of the developed market and emerging market has depreciated significantly. So what FIs are looking at more from a stability of a rupee right now, which is not very visible. So maybe last 2 days it has appreciated because it has corrected a lot. So maybe it can even appreciate marginally further. But if you ask me, worst is behind us and rupee will now going to appreciate, doesn't look like. So again, currency is a pair which is more look for more, less from the absolute perspective, more from a relative perspective. We have to see how global currency movements happen, how the global yields movements happen. Based on till the time that stabilize, FIs will not going to be turned buyer so easily. But if I also look at multiple data points which we track, we think we are getting early signs, and again using the word early signs of exhaustion. It's not completely exhaustion FI selling, which means maybe a month or two, maybe next 2 months time, you might see selling exhaustion happening from the FI perspective. But I will not preempt that. I will like to take that conscious call as and when it happen, because based on our macro data, we still believe that first half of 2025 will be quite challenging from a currency and yield perspective. And within first quarter will be equally challenging. So I am not in a hurry to take that call, whether it will reverse tomorrow morning. But based on the prevailing environment, we have reconstructed our portfolio keeping rupee weakness in mind, and that's the reason we have some large exposure also towards, let's say, pharma or some export company, and largely towards domestic side.
Sandeep, the context that we're speaking in, of course, is a lot of conversation about retail investor behavior in broader market funds. We were speaking to some of your peers as well, trying to understand whether there is redemption pressure that came through in the first 10 days or so of this month. I'd like your insight on this as well. And the second part is, there were a few comments that were made. There are, in fact, a lot of, shall we say, rumors on social media that there are few schemes in the broader markets that may not be able to very easily take redemption pressure, and as a result of which, I'm trying to get ahead of this. You and I have spoken. Sir, one. Just let me complete that point. The stress test results, and we spoke about it when it was introduced. Whether we like it or not, the next stress test result a lot of people are going to focus on. So how do you read that number? And understandably, if free float has come down with market cap erosion, there is going to be a higher number and higher number of days for dilution, right?
So I tell you a very simple answer. Okay. Vested interests do create noise about the market of certain mutual fund facing redemption, or some of the select schemes are talking about. And I think if you've seen last month mutual fund numbers, it does not indicate. As far as we are concerned, we can tell you in last 10 days also we have not faced redemption. We are net inflow. Yes, overall inflow has come down, and we also have been talking about a risk off environment. And if you really sit down and analyze mutual fund data for last many months, in most of the categories, flow has come down, though it is not reflected in overall flow because maximum money has moved to the thematic funds. And this is one point I highlighted few months back also. When extraordinary money goes to thematic fund, typically thematic fund has more risk. It's a classic signs of a high risk appetite that investors are extraordinarily confident and or complacent about market. They are very happy to subscribe high risky products like thematic schemes as compared to flexi or large cap or more diversified scheme, because thematic funds are more concentrated schemes. And that's one of the reason the pain valley which we are seeing today, because we have seen signs of exhaustion. There also the risk appetite is actually peaked out, not only from the market perspective, but from a retail investor perspective. And that was not a good sign. Now to extrapolate because some noise is in the market, I think we would like to say that look at the numbers closely, don't get panic in the market, because people have vested interest in spreading these news or rumors about small, mid or redemption, because everybody has own vested interest for the short-term perspective. So I can only tell you, retail investor have showcased a lot of maturity, and his retail investor is much more evolved as compared to what I have seen in the past. In fact, every fall, at least we have seen our inflow moves up. I think this bull run, which is driven by retail, has many more legs, and I think they have so far showcased maturity as compared to HNI and family office, who have panicked much more than the real investor. Because I keep on hearing in the market, a retail investor has suffered. Retail. If you really define investor, retail investor, they are the people who invest money from their savings. They don't indulge up to that extent in the F&O market. All F&O market is largely HNIs and family office. For them, I always repeat, is a business. This is not the investment which they do. So the good news is that even the leverage position in the market is on the lower side. So I don't think we should really clearly distinguish between the real retail investor and other investors. So real retail investor is still not panicked. That's not the way. Mutual fund data is also endorsing. So I think we should not mix up the HNI float with the retail, and that's a big confusion which is there in the market.
Yeah, Sandeep, not to belabor the point, I'm just trying to get ahead of the number that we will see on the 15th. And I'm only looking at the last 2 months of data, right? Stress test. And I know that we've spoken about it because I look at your small cap portfolio as well, and I see you have very liquid stocks, large cap stocks, 25% allocation to large cap. So in the event of any redemption event, I'm pretty sure that you'll be able to deal with this. But how do you describe that number? It is elevated. And
did I tell you?
Yeah.
You have to understand that part. That's a very theoretical number as far as concerned. Okay. All this theoretical number, if there is an event like September 2008 or COVID, this all numbers will remain like a nice number only on Excel sheet. It has no value. Okay. But events unfold. People don't look into this thing, and just exit is more important at that point in time. So that's very first thing. Second thing, one way of defining data does not give you true perspective of the entire composition of the portfolios. Okay. So if you understand our thesis, since we understand liquidity very well for the markets and the asset classes we talk about, or the country specific liquidity, why we will not understand our own portfolio liquidity? And we as a one fund house, when we started our journey few years back, most of us, almost all the schemes, we don't have exit load. Since people started trading in some of this call, that's the reason we have now 15 days exit load, which is hardly anything. So when we believe that exit load is a more of a psychological game, nothing more than that, we have removed it from our thing. It showcased our confidence that our portfolio are fairly liquid. Okay, that's the first point. Second point, you have to also look at the concentration risk. A lot of people talk about this redemption pressure, don't look at the investor concentration. Okay, as compared, look at the PMS or AIF portfolio. Why they suffer a lot more? Because their portfolio are more skewed towards few investors, and whenever they face redemption, you have seen the panic in the market, where it is more not led by the mutual fund outflows, more of a pressure coming from the AIF family office, PMS and wealth clients, because they take concentrated bet and then they unwind. The concentration risk is very high. So what is very important, if you really look at from a mutual fund industry, is very largely retail driven. The concentration base is very, very low. If you look at, if I talk about our own fund, I don't think anybody own more than 0.2 or 0.3% of my AUM itself. So look at the concentration risk, 90 lakhs folio we have. But concentration risk is insignificant. So you have to look at not only the liquidity aspect, you also have to look at the concentration risk, and you also have to look at the way you have designed your portfolio. What is the impact cost of your stocks which you are owning? So it's a combination. You look at the few examples I've given. It's much more complex than what we look into just looking at the simple number of days exit thing.
Got it. Sandeep, last couple of minutes. Two questions. One, is this a good time to start an SIP in the small cap space?
So Neeraj, anytime is a good time, but what we have to understand is every investor has to assess their risk appetite and their investment horizon. And that is very important. I always say at the peak of the cycle, risk appetite is highest. At the peak of the cycle, everybody has 10 years and long-term investment horizon. What you have to assess, go back on the drawing board and see how you reacted in 2000, what you did in 2007-8, what you did in 2018, what you did in COVID period 2020. And that's the way you assess. Forget any risk management tool or forget any wealth management advisory or your own perspective. Just you as an individual sit down, how you reacted, you will get a fair good answer. What is your risk appetite? What is your investment horizon? Once you assess or reassess that, and somebody comes and tell me that I have 5-10 year investment horizon, I will still say, go and deploy money in small cap. SIP is good for you. But somebody comes and tell me horizon is only 1 year, 6 months, 15 months or 2 years, then I'll say you go for flexi cap or multi-asset fund or hybrid schemes fund, which is relatively low risk, and you can handle that.
Beautifully put. Okay, Sandeep, my final question. I think we've lost him maybe, but we should, if we can, we should just try and get him back for this one final question, because important to understand from him, because he's got this very nice view usually on market-wide valuations and what cycles have taught about what valuation should India trade at and has been trading at and could trade at. I would love to get that view. Okay, I think we've lost that. But nevertheless, let's see. Maybe India remains an expensive market, but we got a crux. And if you have a long-term view, not a bad time to even start or stay with your small cap SIP. So disparate views coming across, but almost everybody who's joined in the last couple of days have mentioned this is not a time to sell for sure.
Absolutely. And in fact, that is the big takeaway. Of course, the equity markets are looking sanguine at this point. Let's see if that strength continues through the day. Fingers crossed.
And viewers will be able to ask you a lot of questions.
Absolutely. In a couple of minutes, we're starting Ask Profit. Unfortunately, we've delayed a little bit, but I'm sure that this conversation that we just had was insightful for you as well to plan your investments over the course of the coming months. We'll slip into a very quick break on this program, and we'll be back on the other side with Ask Profit. Thanks so much for watching.
Entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Sources telling us is that government is expected to provide a roadmap of the next phase of national monetization pipeline, where they are going to set a higher target for the next fiscal onwards.
Building on the success of the first asset monetization plan announced in 2021, the second plan for 2025 to 30 will be launched to plow back capital of 10 lakh crore in new projects.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential.
Hi, thanks so much for joining in. You're watching Ask Profit. My name is Alex Matthew. With me is Mahima Vajrajani, and we're here to take all of your questions on the stock markets. Let's jump straight into where the markets are right now. And in fact, you have a smart recovery from the day's low for the benchmark as well as for the broader markets. In fact, the recovery is as much as 0.8% for the Nifty 50, trading at high point of the day, up about 0.6%. The mid-cap index also trading at the high point of the day. The recovery there is 1.5%. It's trading higher by about 1.3%. The small-cap index is seeing quite a bit of chop and churn. So you've seen right at the end, you've seen a little bit of a deceleration, but it's still trading with gains of about 0.8%. Let's see if the strength continues through the rest of the day. But let me introduce our experts for the day. We've got Nirav Ashar as well as Kush Bora joining in today. Thank you so much, gentlemen, for taking the time, and apologies for keeping you waiting. I also understand that we've got our first caller of the day. Shankar from Chennai is calling us. Hi Shankar, thanks so much for calling. How can we help you today?
Hello sir, how are you?
Very well, please go ahead.
Okay, thank you sir. I bought the NMDC shares, 2000 shares at the rate of 63 rupees.
Okay.
I want only 6 months period I am ready to hold.
Okay.
So what is the target for this?
What is the target? All right. So
minimum 6 months holding.
Okay. So you bought a significant quantity, and 63 is your buy price. Let me go across to Kush on this one. Kush, what are the prospects here?
Hi Alex. Hi Nirav. I think he's got a good entry price. I know the stock's seen quite a bit of correction already. I think there's a good support zone near the 59 to 60 mark. So my first suggestion, given the quantity that he's already built and given the market setup, my first suggestion would be to keep a stop loss around the 59, 60, that zone. On the way up, from a 6-month perspective, the stock is first facing a resistance around the 65 mark, which is the 20-day moving average. But once past that, I think he could look at the target of 68, and once that is taken out, there is a resistance around the 73 mark. So that's the level that he can look at. So 68 and 73 are the levels that he should look at on the upside, and on the downside, your stop loss comes in anywhere between 59 and 60.
Okay, so we've got the next question. Thanks for that view, Kush. Shubhabrata Saha is writing in from West Bengal, and he's asking about Eicher Motors. He's bought 70 shares at a price of 5,276. It's a stock that has taken a bit of a battering over the course of the last few trading sessions. The stock is trading higher by about 1% or so. Nirav, I'll come to you. So he's asking whether to average at this juncture and where to put his stop loss. I guess the second part, I'm not sure if you'll have a view, but from a fundamental perspective, would you say that Eicher should be bought? The numbers were a little disappointing.
Well, it's true that the numbers were a bit disappointing, but I think this is a play on premiumization, and I think if one were to take a long-term view or a medium-term view for that matter, I think it remains an excellent bet. So it can be averaged at the current levels. The thing is that at this point of time, the management has decided to sacrifice margins to a certain extent for the sake of growth. So I think the strategy is likely to play out in the medium term. So definitely it makes sense to average even at the current levels.
All right, so that's the view coming on Eicher Motors. We have our next caller lined up. Mahesh from Bengaluru is calling in. Mahesh, a very good morning to you. How can we help you?
Yeah, hello. Hello, everyone. I'm holding Good Luck India from a past 1.5 year, and I'm purchased the 300 shares of price 803 rupees.
Okay.
Right now it was 7% loss, but I want to hold this stock for a long-term perspective. So is the right time to pyramid more in this counter?
All right, I'll ask your question straight away to Nirav. Nirav, Good Luck India is the counter. What's the view?
Well, I think it will make sense to exit the counter at this point of time and switch to some more reliable names in the metal space. There are better quality names which can be considered.
Like what? Would you name a few?
I think it'll definitely make sense to go in for a Jindal Steel and Power or a Tata Steel.
Okay. All right. So a stock that is under pressure today, let's pull up Natco Pharma, and this is on the back of numbers which were, let's pull up Natco Pharma if we can. It was a big disappointment, right? And you were waiting for a turnaround that has not come through in the third quarter, and the question mark is about whether or not this will come through even in the next couple of quarters. We've got Money, who's writing in from Chennai, who's bought Natco Pharma 200 shares at a price of 980 rupees a piece, and seeing actually it is currently at that price. So the question mark is, would you exit and head off further drawdowns and further losses? I'm going to ask this on the fundamentals because ultimately that is why the stock is reacting. Nirav, what would you say about this? Do you see a turnaround point?
Well, I think this quarter results have been very disappointing, and I think we should wait for the commentary from the management. But I think considering the fact that the results have been so disappointing, that I think we have recommended a few clients to exit the positions and shift to stocks like Piramal Pharma and Divi's Labs.
All right, Nirav, thanks so much for that view. By the way, we have to slip into a very quick break. I know some of you have already called in and you're staying waiting. Thank you so much for your patience. We'll be back very quickly to take your calls. Do stay tuned.
Tax regime for individual. In fact, there has been discussion on how to sort of reduce the tax rate.
I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Government is considering to increase.
Welcome back. You're watching Ask Profit, a show where we get all your stock related queries answered, whether they're fundamental or technical. For viewers who are just tuning in, you can either call us or WhatsApp us on the number that's flashing on your screens right now. We have our next caller lined up. Pradeep from Andhra Pradesh is calling in. Pradeep, a very good morning to you. I believe you have a query on Indus Towers.
Yeah, good morning. I am holding Indus Towers since last 2.5-3 months.
Okay.
And my average price is 353.
Okay.
And I am holding 7,500 shares.
Okay.
I can hold it for 2-3 months.
Okay. So Pradeep, when you bought Indus Towers, you saw the charts, I believe.
Yeah, charts and basically telecom, they are going to pay dividend. That's what I felt. And I bought in that 3% dilution.
Understood.
Done
Understood.
by Voda.
Okay. All right. Kush, since he wants a 2 to 3 months view on the charts, how does Indus Tower fare?
Not bad actually, given the fact that the stock's actually holding ground and consolidating sideways in the market, which has actually seen such a correction. I think this is a fairly good buy, fairly strong buy. However, given the volatility in the market and the stock, my suggestion first would be to keep a stop loss around the 335 mark. Now, on the way up, there is a mild resistance near the 200-day moving average, which comes close to the 360 level. If and when that is taken out, I think the stock will have a good run till 375. So I think you can continue to hold 375 and higher are the targets that you can aim for in the next couple of months, but also keep a fixed stop loss near the 335 mark.
All right. The next question is from Rajaratnam, who's calling us, messaging us from Chennai and asking about IRFC. 2,000 shares bought at a price of 150 rupees per share and looking for a short-term view. Considerable loss being seen despite the fact that the stock is up about 2% at this juncture because of the buy price, which is elevated. Kush, on the charts, what is the view for the short term?
Well, I think there's been quite a bit of selling, in the entire space, in the entire railway space. IRFC is no exception to that. But if you're looking at a silver lining, then there is a positive divergence on the daily setup that is being seen very clearly. Also, for the last 8 to 10 sessions, the volumes on the way down actually have started to slow down a bit. If not dry up, but they've started to slow down. So my suggestion here would be, despite the kind of loss that he's seeing, still continue to hold, keep a stop loss near the low that the stock made yesterday, close to the 119, 120 mark, and hope that the rebound could very well bring the stock to 135, 140 levels. Not sure if he'll make a profit 140, 150 or thereabouts, which is his buying price. But there's a good chance that 135, 140, other levels perhaps slightly higher also. So somewhere closer to the price, his buying price at a slightly lesser loss is where he can exit. But again, here too, a strict stop loss near the 120 mark, which was the low of the day yesterday.
Okay, all right. So that's a view on IRFC. We've got our next caller. Murli is calling us from Bengaluru. Hi, Murli. Thanks so much for calling us. How can we help you today?
Yeah. Good morning.
Good morning.
This question is to the fundamental analyst.
Okay.
I bought a Dolat Dairy, 200 shares,
okay,
at 11.21.
Okay.
Now it is around 1,027. I am incurring a loss of about rupees per share. It means about 20,000 total loss.
Yes, correct.
I am willing to wait for 1 year. And they give me a good result for this quarter compared to last quarter, and they say future looks better.
Okay.
Other expansions, Africa and all coming up in strength.
Right. So you've done your reading, of course.
For 1 year perspective, or you suggest an alternative?
Okay.
Switching over.
Okay, so those are the two options that you're considering: hold or switch. You don't want to add on to your position?
Yeah, I don't want to add on to my
Okay, understood. So then it's a pretty simple question then, Nirav. What is your judgment of the fundamentals of Dolat Dairy, and would you suggest holding on?
Well, yes, definitely it's a hold, because I think these dairy stocks have been doing quite well. The margins have been improving, volumes have been improving. And to add to that, I think the icing on the cake is that value-added products have been doing quite well. Most of these listed players are regional players, and they have a very, very strong presence in their respective regions. So I think Dolat Dairy also fits the bill over there, and very strong tie-ups with the farmers over there too. So I think definitely it's a hold from the current levels with a medium to long-term horizon.
View coming in on Dolat Dairy from Nirav. The next query that we have is on flare writing. Mazmudar is asking this query. He's holding around 336 shares of flare writing, bought at 305 a piece. He wants to know the outlook for this particular company, since he's not mentioned whether it's a long-term or a short-term view that he wants. Kush, I'll come to you. Flare writing, how's it faring on charts right now?
Not so great actually. The stock's actually just seen correction ever since it listed somewhere, I think around November of 2023. It's on the way down. Any particular rise that has come about, any meaningful rise that has come about, has actually only seen selling pressure very clearly about, below the key averages. I think this one's a very clear exit. So flare writing, despite the kind of loss that he's seeing, I'm afraid, it's an exit from a technical standpoint.
Okay. All right, it's an exit on flare writing, and unfortunately the drawdowns are significant despite the gain that you're seeing in the share today. Now, Pradeep from Chennai has made an interesting observation. He says in his history, he has never participated in any bull market, always participated in all bear markets. He's bought Jupiter Wagons at a price of 360 rupees and quantity of 800 units, and he is now under, he's seeing a loss to the extent of about 23,000. It's a very simple solution though, Pradeep. If you stay invested long enough, you will catch a bull run. And that's exactly what I told you in chat as well. But let me ask this question to Nirav. Nirav, how does this look? Jupiter Wagon, not a specific mention in the budget, but then the view is positive on these rail stocks. Wouldn't you agree?
Well, that's true. But I think the railway stocks have unfortunately hit a speed breaker and started moving in reverse direction. So I think that's where most of the investors have been caught on the wrong foot. Now the timing of the entry in the railway stocks is very, very crucial, because for those investors who did not catch the story early, we had the valuations run up very, very fast. And unfortunately, most of the investors entered at a very later stage, and that is what has resulted in the current situation. So I think definitely at this point of time makes sense to hold, but I think patience will be required for the investors before they are able to get a reasonable return on the railway stocks.
Right, so that's the view coming on Jupiter Wagons. The next query that we have is from Manohar, who's from Pondicherry. He's asking whether it's the right time to enter ITC hotels or not, and if not, when would be the right time to enter, because he's looking from a longer term perspective to enter this counter. Nirav, I'll stick with you for this one. What's the view with respect to ITC hotels?
Well, yes, definitely the most opportune time to enter this sector, and of course this particular script, which is ITC hotels. If we see the results have been quite strong, the ITC results, they are showing ITC hotels perform quite well. And I think the expansion plans are likely to play out. We'll see a whole new pedigree of investors also entering into this hotel space with much more focus and more clear capital allocation.
All right, so it's the right time to enter is the view coming in on ITC hotels, and as Neera rightly mentioned, the growth that it is penciled in this quarter is quite impressive. We have our next caller, Anand from Hyderabad is calling in. Anand, a very good morning to you. How can we help you?
Good morning, Mahima. Good morning, Alex. I was holding Foseco India,
okay.
22 shares,
okay.
4,165.
Okay.
So I wanted to know, can I average it or should I hold it?
Okay.
And I wanted to know more about the fundamentals of this.
Okay, Anand, a very interesting company. I just want to understand as to how you came across this company, because it's engaged into manufacturing of products that are used in metallurgical industry.
Metallurgy.
Yes,
Yeah,
so very
yeah,
interesting company. How did you come across this, and what's the kind of study that you've already done?
Watching the channels, and that's how I got to know this company.
Okay.
And the results were good, and about the metal erosion, they have their product over there.
Right.
So I did a little bit of study over there. It was not going below 4,000 for a long time.
Right.
But during this fall, this year itself, it has gone below 4,000. So that's the reason I was a bit worried. And moreover, the result has not come yet.
Right.
So I saw that the results dates are also not announced yet. So I was like thinking, it has already come down from 5,000 to almost 3,600. Can I go ahead and buy more?
Got your query, Anand. I'll take your query with Neerav. Neerav, if by any chance you have a view on Foseco, it's a comparatively small company with a 2,300 odd market cap. But if you have a view on the company?
Oh, well, yes. Such companies are, if they are there in the portfolio, I think he should not dispose them off. It makes sense to hold these stocks for a longer horizon. The simple reason is that most of these are Pharma companies, and they have a small equity base, virtually zero debt. They tend to have technology leadership. And I think one or two bad quarters also, there is no problem. One should average also, as a matter of fact. So I think all these companies which fall into the pedigree of Foseco India, or companies like Linde, Ingersoll Rand, or the likes of John Cockerell, I think all these stocks are a must-have in the portfolio, but they should be held with a medium to long-term horizon without getting panicky if there's one or two bad quarters.
Interesting. An interesting spot there, and kudos to you for having done your research as well. Let's take the next question. This is from Bhaskar, who's writing in from Hyderabad and asking about Bama Lorry. He's bought at levels of 240 rupees and he's holding since September of 2024. The stock is currently at 175. What's the view on the charts, Kush? Would you book losses and move on to something else?
Well, sharp correction, in the last couple of months, that if you see, or maybe a little longer than that. However, even now, if you see, the stock's actually not seen any kind of a meaningful revival. So for the moment, given the kind of setup that the stock is seeing, and even the momentum indicators pointing south, for now it's not a bad idea to exit. Maybe somewhere close to the 150, 160 mark, a re-entry can be considered. But at the moment, the kind of move that the stock is seeing on the back of fairly decent volumes, this is an exit.
All right, we've got our next caller. Parvati from Andhra Pradesh is calling us. Hi Parvati, morning. How can we help you today?
Hi. Good morning, sir.
Please go ahead.
I bought 100 shares Shakti Pumps and 12.15 the price rate.
1,215?
Yeah.
Okay. So, what was the thinking when you bought it? Did you buy it for the long term, Parvati?
One kind of 6 months to 1 year I hold it.
Okay.
What we will do?
Okay.
I mean, wait or exit.
Okay. Understood. And so, okay. So basically you want to know, and when did you buy this exactly?
I forgot. I mean, I don't know actually. Okay. My husband handled it.
Understood. Okay, let me ask you a question to Kush then. Kush, it is at, if I'm not mistaken, let's pull up the intraday chart. Is it at upper circuit right now? Let's pull it up and see. So it is apparently at upper circuit. So no sellers in the stock right now. What is the upside potential? Can she recover her buy price of 1,215? As she pointed out, she's got a 6-month time frame.
Maybe a little longer, anywhere from 9 to 12 months, give herself more time. There's a good possibility then, that she might recover, her loss or maybe significantly reduce it, if not entirely recover. A couple of silver linings or positives on this is that, the stock starting to see positive divergences on the days when the stock is closing higher. The delivery market volume is also significantly higher. There's a falling trend line resistance that the stock is about to, cross just above this 905 mark. So my suggestion would be continue to hold. Positional stop, even now, the kind of levels that the stock is seeing, I would suggest a positional stop near the 850 mark, but continue to hold. Within, I think, about 9 to 12 months, the stock could move significantly higher. As I said, if not profit, could at least significantly reduce the losses that she's making currently.
All right, so that's the view with respect to technicals of Shakti Pump. The stock is up by about 5% as we speak. The next query that we have is from Ashik, who's from Bengaluru. He's holding Reliance Power 3,000 shares bought at 43.7 a piece. He wants to know whether he should currently hold them or sell them. He's sitting on a loss of roughly 11,000 odd rupees. Kush, on the charts, how is Reliance Power faring?
Not so bad. There's a consolidation, and I'll give you a broad range on this one, and that is from 36 on the downside, and on the upside, this 44 or thereabouts. So still holding on to it, short-term averages very close to those levels. Given the market setup, the relative strength is very apparent. So I would suggest continue to hold, hold on to Reliance Power. 37, 36, that zone will now start acting as your stop loss. On the way up, as I said, 44, which is fairly close or just above his buying price, is actually a bit of a resistance, but once that is taken out, you'll need to hold, place a stop loss between 37 and the 36 mark.
All right, so hold is the view coming in on Reliance Power with respect to the charts. The next caller that we have is Srinivas from Bengaluru, who is calling in. Srinivas, a very good morning. How can we help you?
Very good morning. I'm holding this stock called BEL for the last 4 months. At 312, average around 1,500 shares.
Okay.
The query is, should I average it because another 2 lakh rupees I have? Should I average it here for 9 to 12 months of time, or should we go to Lemon Tree?
Okay, that's an interesting comparison. Nirav, he's comparing BEL with Lemon Tree because he wants to know whether he should exit the counter. He's sitting on a loss of roughly 71,000 odd rupees. Should he keep holding BEL or book losses and switch to something like a Lemon Tree is his question.
Well, I think BEL has been a slow mover in the markets. I think per se the results have been quite good. We've seen a very consistent performance. We've seen good order book. So I think it makes sense definitely to hold on to BEL for some time. And I think as far as Lemon Tree is concerned, I think there are some other better alternatives which are available in the market. So I think if you are looking at hotel stocks, then I think you could probably look at an Indian Hotels or an APJ Surendra Park Hotels at this point of time.
Interesting. Let's pull up Lemon Tree and see what it's doing in trade today. Remember, it's a stock that we marked in the open because there was a considerable upside that was being pegged. 63%. I remember that correctly. Macquarie has a note out both on Lemon Tree as well as Chalet Hotels. 57% upside seen on Chalet Hotels and 63% upside on Lemon Tree Hotels. Both are up and about, but not considerable upside at this juncture. Let's see if that pans out, and hopefully that answers the question. We've got the next question that we're taking, and this is on DLF. This is Abhishek, who's writing in from Amchi, Mumbai, and he's bought 1,000 shares at a price of 695 for the short term. He's wondering what the prospects are. So he's lost a little bit of ground, not a lot. 687 is the current market price, 695 is the buy price. Kush, what should his strategy be?
Well, I think the saving grace for him right now is the fact that, he's bought it at a price which is not significantly high, close to what the current price is. Now, given the kind of fall that the stock has already seen, some positive divergences emerging, not a bad idea to continue to hold. But again, keep a very strict stop loss near the 660 mark. That's the medium-term support that the stock has. If that is broken, then there's a possibility that it could head lower. So keep a stop loss near the 660 mark. I don't see a meaningful revival in the sense that it might not see a V-shaped recovery and head to those 750, 800 levels that it made in the last swing high. But yes, there could be a technical bounce basis the kind of shorts that the stock has already seen, and hence a short covering rally and a bounce from these oversold territories is quite likely.
All right, so that's the view coming on DLF. We have our next caller, Swapnil from Pune is calling in. Swapnil, a very good morning to you. I believe you have a query on Eid Parry.
Correct. A very good morning to you and all.
Go ahead with your query.
So I have brought this Eid Parry sometimes 2-3 months back.
Okay.
2950 shares for 843. Currently I'm losing 6%.
Right.
But I want to see the long-term perspective as they are also getting into the corn-based ethanol,
right.
And mainly in the sugar. But as government controls those prices after taking that stock, I'm a little worried. What should I do for long-term?
Got it. I got your query, Swapnil. Nirav, I'll come to you. With respect to the numbers, they looked good prima facie. It posted its Q3 earnings day before yesterday. But in terms of what augured the growth was the animal feed business for them and not the sugar and ethanol business, because that was a weak point, which is why we did also see, a downtick in stock yesterday. But what's the view with respect to EID from a longer term perspective?
Well, the view is positive because stocks like Eid Parry are portfolio stocks and basically they are not bought for the short term but for long term gains. And we have a very good quality management. It's very well diversified. It's got a presence into sugar, fertilizers, animal feed, and a lot of other specialty products in the pipeline. So I think he should keep the faith and hold on to the stock. The sugar story has been under pressure for some time, but hopefully things should reverse going forward. And they also have a sugar refinery. So I think the prospects are quite strong in the medium to long term.
Okay, prospects are strong for Eid Parry. Hussain is calling us from Kolkata. Hussain, good morning. How can we help you today?
Sir, good morning. Yes, sir, I have bought a stock name Hindustan Copper.
Hindustan Copper, yes. Okay.
Okay, and the price is 291 at the price of 379.
Elevated levels. When did you buy this, Hussain?
I still remember during the month of May.
May. Okay, May last year is when you bought it. So therefore you had a long-term view on this and the prospects were looking good for the copper space as a whole, if I remember correctly. What would you want to know today?
Sir, currently I just want to exit.
You want to exit. So you want to know the best price to exit. So you've studied the fundamentals and you see that it's not worth holding for the long term. Is that correct?
Yes, yes. Currently, if I'm going to lose it close to 7 or 8 months, I'm not getting any return.
Yeah.
So yes.
Okay. So, all right. So, point taken. Let me go across to Kush then on Hind Copper. 231 current market price. Very elevated level. 379 is the buy price. So, basically, the idea is to recover some of the losses. I don't think the expectation is to recover all of it. What are the strategies that you would employ to sell this stock?
First up, I appreciate the clarity. He's very clear that there isn't too much of gains to be made on this one, and by that I mean profit and loss. That's not to be made on this one. So kudos on the clarity at least. Now the stock is attempting a base formation near the 220 mark. If you see over the last month and a half, 4 times the stock has actually tested that mark and tried to rebound. So give yourself that chance. The answer is actually more from a trading strategy perspective. Combined with the technicals, which is keep a stop loss around the 220 mark. Give yourself some chance. There is a chance of short covering rally on this one as well. Like we discussed for DLF just a while ago, it's seen massive shorting over the last few months. So this could very well see some sort of a revival from those levels. 220 is the level where I will keep my stop loss. On the upside, the numbers that I'm looking at, first is 250. Once that is taken on, you're looking at 275 kind of a jump as well. So that would reduce his losses to an extent. So and the stop loss from here on is not too deep, considering where the stock has fallen since its buying price from. So 220 is the stop loss. Continue to hold for some time, and you could start exiting partially around the 250 and the 275 mark.
Right. So it's a comprehensive view coming in from Kush on Hindustan Copper. The next query that we have is on DAM Capital. Vamsi from Andhra Pradesh is holding 100 shares at an average price of 314. She wants to know whether she should average at current levels, and is it a good fundamental company? Is it a good company fundamentally to keep holding for the next 2 years? Nirav, your view with respect to DAM Capital?
Well, I think it's a good company to hold with a medium to long-term horizon, but I wouldn't recommend averaging at this point of time.
Okay. All right, it's time now to hit the rapid fire segment, and both of you know what this is. We'll spend 2 minutes and we'll toss as many questions at you as possible. Do keep your answers as crisp and concise as possible. The first question is from Zia. Signed DLM is the name of the counter. Bought at levels of 779 on the 26th of August 2024. The stock is down. Would you hold or would you exit? This one's for you, Nirav.
Hold.
All right. Juniper Hotels is the next counter. Nagraj from Hyderabad is holding 40 shares at 360 a piece. Should he hold from a longer term perspective, Nirav?
It's a hold.
Okay. Renuka Sugars. Ajay from Pune wants to know long term prospects. Bought in September. Average rate is 56. Should you hold or sell, Nirav?
Sell.
RVNL is the next counter. 200 shares bought at 154 a piece. Should the person hold or exit? Your view, Kush?
Hold.
Acme Solar got allocation in IPO. Rajan wants to know hold for the future or not. Nirav?
No, exit.
Ashoka Buildcon is the next counter. 120 shares bought at 239 a piece by Shweta. She wants to know whether she should continue from a longer term perspective. Nirav?
Yes, hold.
Nestle bought at a price of 2673 for the long term. Vinod wants to know, can you hold? Nirav?
Yes, hold.
S. Kumar from Mumbai is holding 10,000 shares of Ujjivan Small Finance Bank bought at 61 a piece. Should he wait or sell at current levels? Kush?
Exit.
CAMS, would you buy at this level for the long term? Is a question from Antriksh. Nirav?
Yes.
All right. Acme Solar. Did we? Yes. Okay, we took. Okay. Renuka Sugars is the next counter. 2,000.
We've taken that. PNB, 20,000 shares bought at a price of 109. Short-term view. Kush?
Continue to hold. Keep a stop loss near the 93 mark.
All right. The next counter that we're talking about is Vishnu Prakash R. Pugalia. Surya from Kurnool is holding at an average price of 253. Your view, Nirav, on this one?
Sorry, I didn't get the stock.
Vishnu Prakash R. Pugalia.
I think I'm not...
okay, Kush, on the charts then?
Exit.
Exit. All right. Well, that brings us to the end of this edition of Ask Profit, and it's been an absolute pleasure. Nirav, Kush, thanks so much for joining in. Pleasure having you. We've covered quite a few stocks today, and hopefully the stocks that we discussed have benefited you. If we didn't get your question answered, we'll be back tomorrow to take more of your questions, so do stay tuned. In the meanwhile, lots more coming up on NDTV Profit. From Mahima and myself and the team that put the show together, thank you so much for watching.
जब भाषण सुना उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR।
entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Sources telling us is that government is expected to provide a roadmap of the next phase of national monetization pipeline, where they are going to set a higher target for the next fiscal onwards.
Building on the success of the first asset monetization plan announced in 2021, the second plan for 2025 to 30 will be launched to plow back capital of 10 lakh crore in new projects.
Hello and welcome to KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every day. Well, today we're talking about electronic Mart India. This is India's fourth largest consumer durables and electronics retailer in India. Well, it's largely based in the southern regions, southern India, and it just focuses on a diversified product offering across about 100 brands. Well, Electronic Marts also has, while it does have stores under its own brand, it also has several others in terms of comprising of more than 8,000 SKUs across different product categories. Now, this particular company has come to the fore over the last few years, even as we see takeoff in retail in India, and considering we do have a lot of listed retail players, but none in the consumer durables and electronic space, which does make Electronics Mart a very, very unique, listed entity at this point in time. Now, let me tell you about how things have fared as far as its presence in India is concerned. So, firstly, it has about 178, MBOs, that's multi-brand outlets. This is followed by about 13, exclusive brand outlets. And as I've said, that it has about 8,000 SKUs, and it has current retail business area of about 1.69 million square feet. A lot to talk about, but I reckon that it's gained most of its tractions through its multi-brand outlet, because that's where it's built itself out. Of course, in well, I would say the private space, it does appears in something like a Chroma or a Vijay Sales. But given the fact that its presence and dominance is more towards the southern India, it's also making a little bit of headway towards the northern India, in some markets, which would include, well, the NCR region and Chandigarh and so on and so forth. But in terms of store ownership, again, this is another crucial one to keep an eye on, because it gives you an idea about how many of these stores it owns and how many of these stores it has leased out. So it does have about 11 stores which it owns. About another 137 leased out, and it also has about 12 which would pre-owned and then leased. And so it's certainly a very interesting mix. Do remember that when a company actually owns a store, well, it doesn't need to shell out rent for that particular property, and that always works out well to your advantage. Well, case in point, of course, DMart is the other one. Of course, it doesn't operate in consumer durables and electronics, but it's certainly an advantage. It does seem like at the moment, though, majority of all the stores that the company runs currently, about 137 to be precise, are leased. Well, with that, and on that note, let's shift focus to all the parameters that we are talking about. Now, as we always do, we assess the company based on the fundamentals of what the company has done over the past few years, and take it forward from there. So we do address your income statement, not just revenues, but the income statement as a whole. We talk about the balance sheet as well as the cash flows, and along with that, we also talk about the revenues return ratios as well. Moving on, we also have shareholding, street credentials, valuations, and street coverage. So, without any delay and a further delay, let me get in my colleague Mahima, who's also going to join us to give us an idea and shed more light into the company and what the company has done so far. So Mahima, good morning and thank you for joining in. Let's start as usual by talking about the income statement. How have the revenues and profitability turned out for this company?
Right, Agam. Good morning. In terms of revenue, the metrics we've given a thumbs up to this metrics, because overall, if we see the revenues so far in terms of 3-year CAGR, they've grown by about 25%. EBITDA has grown by about 30% CAGR in the past 3 years, and net profit has grown at a CAGR of 46%. In terms of margins, the margins have taken a slight hit when it comes to 9 months FY25 number. They've come down to around 6.4% versus that of 7.2% FY24. So we'll have to wait and watch out as to how FY25 overall settles when it comes to margins. But revenue has grown at a decent CAGR. In terms of the split, the 42% of their total revenue comes from mobiles, 45% comes from large appliances, and small appliances and IT contributes around 13% to its total revenues. In terms of key operational metrics, same-store sales growth was at 3.8%. This is of course 9 months FY25. The net retail sales per store was down by about 15%. Average ticket size was down by about 1%. Bill cuts were up by about 12%. So overall, Agam, it's a thumbs up since 3-year CAGR paints a good picture. But in terms of the operational metrics overall 9 months as well as Q3 are a bit under pressure because of the consumer demand sentiment that has been the case so far in the consumption space as a whole.
Right. Well, I just want to make a very quick point on margins. So this is a retail company, and naturally we're expecting margins to usually not be considerably high. But I'd still want to take the case of perhaps something like a Trent, where the margins are standard around 15-16%, and I know the apparels business cannot be compared to that which is into consumer durables. But in overall margins profile, and in general, again, retailers who come through and run these businesses, their margins are short, but it does seem like Electronic Mart's margins is towards that lower end of that range. So it'll be very interesting to know whether or not there is further scope in improving margins going in. And I'm just making this point because we're in fact talking about the income statement. But as Mahima has pointed out, say for that, we're actually looking at some strength coming in over the last few years. I'll talk about the balance sheet, and naturally, given the fact that you do see such strong operating metrics, you see such strong profitability, well, we will have accumulated profits on its balance sheet. So its net worth stands at around, well, nearly 1,500 crores by the end of the second half this financial year. And this is, of course, also moved up as compared to FY24. If you consider the gross debt, that has also increased a little bit. And well, cash and bank, I reckon, stays the same. Well, you know, we were on the fence of whether or not we should give this a neutral rating. And we were considering a neutral rating because its gross debt has moved up. But if you consider the gross debt with respect to its accumulated profits, that is the net worth, well, it's still not that high, which is why its balance sheet is still looking like it's in a strong place. And hence, we're going to give this one a thumbs up as well. So that's as far as, you know, your overall, you know, net balance sheet is concerned. But, you know, Mahima, let's talk about the cash flows too. How do they look like?
Right. So, with respect to the cash flows, you know, Agam, cash flow from operations has remained strong. You know, in FY24, it stood at around 330 odd crores, but that has improved to 358 odd crores in second half of the first half of FY25. For net cash flows, if we see FY24, it was a negative net cash flow of around 118 crores, but that has improved to now a negative cash flow of 37 crores, which is why we've given a neutral rating to the company, because the net cash flow is now improving, you know, every year, which is why since it is still in negative, we've not you know, given it a thumbs up, but since it's improving, we've given a neutral rating when it comes to the cash flows.
Right. And you know, I'm going to wait for a further judgment on this particular company, because I reckon that your year-end numbers for cash flows as well are a little bit more important, and it'll give you a better idea of how things have panned out through the course of the year. But as Mahima said, that we are looking at improving metrics. So that said, you know, let's talk about the return ratios, because that's which will tie up some of these income statements. And as far as return ratios are concerned, firstly, they're not at the desirable level. If you consider the return on capital employed, you prefer a 20% you know, return on capital. At the moment, it's closer to that, and there's been an improvement over FY23. So it's going to be a good one, but because it doesn't make the 20% mark, it's a neutral. It's the same for ROE. ROE actually has come off quite a bit from 2022. From 17.4% all the way down to around 13.4%. So this is another reason why we don't want to give it a thumbs up. You know, and we're going to go with the neutral here, because we are looking at some amount of, well, deterioration in return on equity specifically. So it's a neutral rating for return ratios. And now that we are done with your overall income statement, your balance sheet, as well as cash flows, and assessed it with some of your return ratios, let's move on beyond these financial statements and talk about shareholding. Mahima, what can you tell us about this?
Right. So in terms of shareholdings, again, you know, Electronic Marts India is a well-held company, because promoters are still holding around 65% of the total equity. However, that has gone down from around 78% odd in September 22 to around 65% now. That is in December 24. In terms of the FIIS holding, that has increased to 9.2%, which was around 8.8% in September 24. But FIIS have significantly increased their stake from around 2.5% in September 22 to 9% in December 24. In terms of DIs, the stake has reduced as compared to September to around 17.9%. But DIs have also, you know, over a period of time increased their stake in this particular counter from 7.5 in September 22 to around 17.9 in December 24. And lastly, public shareholding has gone up to around 7.6%. Public shareholding has come down a bit from around 12% in September 22 to around 7.6% in December 24. But overall, since promoters are holding, you know, over 65 odd % stake in the company, it's a well-held company, and which is why we've considered giving a thumbs up when it comes to the shareholding pattern of the company.
Yeah. Yep. Okay, so let's talk about the price action for the share price now. And well, it's not been a desirable one. Look, we must acknowledge what's happened in the last 4 months, 4.5 months actually, if you consider February 2, that the mid-cap and the small-cap space particularly has taken quite a hit. Well, from October onwards all the way to mid-February now, we have seen somewhat of a correction which has actually played out very, very poorly with respect to a lot of your portfolios. And I'd reckon that the size at which Electronic Mart is in terms of its market capitalization, it is going to be susceptible to this correction along with the rest of the market. That said, the decline on a one-year basis is by as much as 38%. Now, this is not the best kind of return, even on a relative basis with compared to some of your other peers in the mid-cap and the small-cap indices. Well, there has been a little bit of an outperformance as compared to Electronic Mart, which is why it's not the most desirable of returns so far on a one-year basis. Calendar year to date is also when Electronic Mart is down around 20%. And if you just consider the returns over 5 years, well, the returns have not been good. It's not been a multi-bagger, as in it hasn't even doubled over the last 5 years. In fact, it's giving you half the returns of your expectation of doubling over the last 5 years. So in terms of returns, well, it's certainly not been a great one, which is why we will give this one a thumbs down. But I'd reckon that if you don't have returns, it does bode well in terms of valuations. But let's find out with Mahima. Mahima, what can you tell us about that?
Right. So, Electronic Mart's valuations with respect to the 12 months trailing PE, it stands at around 27.6 odd times. Now, Electronic Mart India does not have, a listed peer per se, but it does have competition from the unlisted space, when it comes to Reliance, retail, there's Chroma, there's Vijay Sales, which gives it competition. But with respect to the valuations, the 12 months trailing PE, as I mentioned, is 27.6 times. It goes to around 29.2 times in 2025 as per Bloomberg estimates, and 2026 it goes to around 23 times. So not a significant dip when it comes to moving from 27 times to 23 times in 2026 as per Bloomberg estimates, which is why a neutral rating is something that it's called for. However, in the consumer durable space, if we compare it to although they are not like for like peers, but the peers that are present in the consumer durable space, that is your Blue Star, your Voltas, etc., are trading at a much higher P. That is also one of the reasons as to why we've given a neutral rating when it comes to valuations part, Aga.
All right. Well, there you have it. That's coming down to what we were talking about. Well, valuations. I'll finally sum it up with what the analyst community is making of the company, and they're all positive. So we have about 6 analysts covering the company, and all 6 have a buy rating on this, and with an upside potential about 47% from current market levels. What we are seeing here is well, in general, that the analysts are expecting a little bit of a recovery from current market levels based on the fundamentals that we've seen, and which is why we will give this particular aspect a thumbs up. With that, let's talk about how things have fared in terms of all the parameters that we've spoken about, and what is the overall total rating for the particular company. So, at least as far as your performance in terms of your revenue growth, your balance sheet so far, cash flows, return ratios, all very, very steady over the last few years, which is why it's a thumbs up, at least for the income statement and the balance sheet. We're looking at a very strong shareholding. We have good street coverage and good anticipation of an up move. Well, street credentials, the return that the company has given, the share price has given, is not not the best so far, but again, fairly neutral in terms of valuations to fairly reasonably priced at the moment. So taking all these factors into consideration gives us a total rating of around 5.5 out of 8. So there you have it. That's the rating for Electronic Mart. Now, I believe that we do have the management of the company standing by, but before we go across to the management, I want to very quickly talk about the SWOT analysis. So in terms of strength, we're looking at the South cluster growing at a fast pace, and there's rapid store expansion, so obviously going to play in favor of the company. In terms of weaknesses, same store sales growth still needs to see a little bit of a pickup to have a meaningful impact on your future outlook. And of course, at the moment, the entire environment is soft with respect to demand. so that's not going to exactly be a tailwind for the company. What about opportunities and threats, Mahima?
Right. So in terms of opportunities, the right product mix and competitive pricing is something that will bring them an edge. Exploring more into quick commerce and e-commerce is something that will also bring in a lot of opportunities, and exploring new geographies, because right now they're more focused towards the southern markets, will bring in a lot of opportunities. And in terms of threats, there might be mobile life cycles are kind of increasing, which is why the customer repeat segment is something that is a threat. In terms of inventory being piled up due to technology changing very fast could be one of the threats. And competition, of course, is pretty high when it comes to although from the unlisted players is very high, and which is one of the threats to consider.
Okay, well, no better time then to bring in the management of the company. We have Premchand Devarakonda. He's a CFO at Electronics Mart India, who joins us on the show. Premchand, good morning, and thank you so much for taking the time out. Interesting times, and while you have seen so much growth over the last few years, it does seem like the overall demand environment in terms of consumption for India, and especially the markets that you operate in, are looking at a little bit of moderation. What is your own assessment of the current demand environment?
Thank you very much for having me on your show. Last 2 quarters was little disappointing, because there is a lot of maybe because of the high food inflation, so the disposable income of the customers has gone down, as well as there is stiff competition in the markets where we have been operating. And when the competition increases, obviously we have to pass on additional discounts to the customers. So maybe these are the reasons. And also, moreover, so the average selling prices of certain categories have come down drastically. That means by 30% in certain categories as compared to last year's. So all these things contributed to little upset in this the couple of quarters. Otherwise, when we looked at the quantity growth, it was quite promising. And since 1st February, again, the situation seems to be improving and promising. And we are quite optimistic that in the upcoming quarters, we will be back on track in all respects.
Right. Mr. Devarakonda, Mahima also joining in. With respect to the margins, I wanted to understand that, 9 months FY25, they stood at 6.4. But this quarter, they had come down to around, 5.2% when it comes to the EBITDA margins. So I want to understand, because your margins have been, over 7% as well. When do you expect the margins to recover to the levels that they were, and what will be the levers that will lead to the margin growth?
See, again, the margin growth depends on the product mix. So normally what happens, there are certain categories like large appliances, IT and mobile, and then the small appliances. So if the product mix changes, normally it changes in the first quarter, where the movement of white goods is higher as compared to other categories. That means the contribution coming in from the sale of white goods will be better. So if that trend continues, that means if we have extended summer, so obviously we will have the improved margins. But the Q3 was an exceptional quarter. So it will happen once in lifetime. So hopefully, so that trend may not be there in future. So that scenario may not be there in future. And for the first 9 months, we were at 6.4% of the EBITDA. So that might, even this year we might end up at 6.5%. But from next year onwards, and we are optimistic that we are able to sell the attachments along with the products. So those things will definitely contribute to the better margins. Coming back to by end of next financial year, we might come back to the 7% EBITDA margins.
Premchand, I also want to ask you about how you all are going about when it comes to ownership of your stores as compared to leasing of stores. Is this what you all have done so far going to continue, or are you also seeking to ideally also own few more stores in a ratio? Do you think that this ratio could change going forward, or does that depend from situation to situation?
See, it is on a case-to-case basis. If we get a good deal at the good location, we might look at the option of acquiring the property. Otherwise, our strategy is to keep the ratio of old stores and the new stores at 1:6. So that might continue, not even 1:6. It is, it's around that. So we will maintain that ratio in future.
All right. And in that case, if you could also very quickly tell us about your store expansion going into FY26. Do you guys have some numbers in mind?
See, for next year, we are planning to launch another 30 stores. So out of which 6 stores will be in NCR and the remaining stores will be in the South Cluster.
And will these be MBOs, EBOs? How will the split come through?
See, MBO is never there in our master plan. So MBO is a goodwill gesture that to maintain the relationship with various brands. We'll launch the EBOs. It's EBOs. So when our plans are always about the MBOs. So when we talk, it is only about MBOs.
Okay, Premchand, we'll leave it at that. Thank you so much for joining us and taking us through what we can expect from the company going forward. Well, there you have it. That's the management of Electronic Smarts India telling us about all that we could, they could expect coming through over the course of the next few quarters. There is expectation of an improvement in margins based on the change in product mix, which would of course favor higher margins. But it's going to be a wait and watch. We do know that the demand environment could see a little bit of an improvement as well, given the kind of current inflationary challenges that we do in fact see facing the consumer. But on that note, I'm going to thank Mahima also for joining us, and also, that is the end of this edition of KYC. But stay tuned to NDTV Profit, and we'll keep bringing you more.
Tax regime for individual. In fact, there has been discussion on how to sort of reduce the tax rate.
I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Government is considering to increase the custom duty on the imported finished goods ranging from consumer electronics to medical devices.
And to rectify inverted duty structure, I propose to increase the BCD on interactive flat panel display from 10% to 20%.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with.
Hello and welcome to Markets at 12. This is Anushri Vakharia. Let's take a quick look at how the markets are doing currently. All the three indices, if you are seeing the broader and the benchmark and markets all in green today, this is of course favored by the retail inflation data also which came out. We're seeing gains of around 0.75% in the Nifty 50, mid-cap 150, 250 seeing gains of around 8.82% and 1.33%. Now this is a sigh of relief after the kind of shortfall, the sea of red that we've seen in the past few sessions in the small cap and the mid cap space. If you had to look at the sectors, what is happening in the sectors, all the sectors are doing well in the green territory except for Nifty IT, which is seeing cuts of around 0.15%. Nifty Metal, though, the top gainer seeing 1-2% of gains, followed by Pharma and PSC indices seeing about 1.78 to 1.77% of gains. Coming to what is happening in the top Nifty gainers for the day, Tata Steels, Bajaj Finance and Cipla in focus seeing seeing gains of around 2 to 3%. But this is as far as the benchmark and the broader market indices are concerned. Let's shift focus to the management. So we got a chance to speak to Sanjay Kumar Jain, the Chairman and Managing Director at IRCTC, after the company's Q3 earnings. Listen into that conversation where he gives outlook for the coming quarter as well.
IRCTC in Q3 25 has achieved a revenue of 1,225 crore and its profit grew by 14%. Both on revenue and profit front, we have achieved highest ever results, and I am further happy to inform you that we have given highest ever dividend this year. Last year we have given a dividend of 520 crore. This year, after this announcement of interim dividend of rupees 3 per share, this year till now we have announced a dividend of 560 crores. So we are in 4 segments of business: e-ticketing, catering, this rail neer and tourism. All our segment has improved over to Q3 24, but this rail neer and tourism business has improved a lot with a 16% growth in both the business. So there is no pressure on any of the business, but your concern was there on catering. So let me clear you that we have started implementing a new catering policy which came in November 2023 from October 24, and this is a short-term phenomena, because any change in the policy, something legacy works for some time, but looking forward this will all go and our catering business will improve further because of 2 reasons: stabilizing of this catering policy, wherein we have already created a network of kitchens infrastructure all across India, and new number of trains, Amrit Bharat and Vande Bharat trains are going to come in near future, which will be able to serve from these kitchens and will be thus able to score better license fee and better margin. Second, catering business is the creating an optional platform of e-catering, wherein we have robbed in all the major aggregators, food aggregators, and here our profit margin was 15%, and we have recently changed our tender and contract, and we are expecting a revenue growth of 22% margin into that.
Mr. Jain, give me an idea of the top line growth that you're anticipating. 10% is what you achieved in the quarter gone by, and it's a strong quarter. Q3 is generally a strong quarter, isn't it? So where will you end the year at, and heading into next year, are you perhaps a little bit disappointed that there was no specific announcement on the rail side in the budget?
You see, we are into servicing the passenger aspect of the railway business, and we have huge potential to achieve. We are far lagging behind at present itself in servicing the customer's need, and we are consolidating our position to enhance our capability to serve and to trap these potentials. If I talk of like a rail neer, there is a capacity requirement. There is a demand of around 25 lakh to 30 lakh bottles depending upon the season. We are only 18.4 lakhs bottle plant capacity as of now. So our main challenge is how to trap this flowing business and enhance our revenue and margin both. So our management, IRCTC, is planning to trap all this business which is flowing. And certainly our volume is going to grow further. Our revenue is going to grow further.
Is there a number that you have in mind, sir, or so is this going to be in line with what we've seen so far, 10% growth, double-digit growth expected in the new financial year, and also the margins? You mentioned certain measures that have been taken in the catering business. Do you think that they will stabilize where they are right now, or will they improve further in FY26?
I already told you in both the business it is going to improve. And so far as outlook is concerned, not only the flowing business, you see, Railway is announcing a number of new trains like Amrit Bharat and Vande Bharat trains, and all our 4 business are related to this railway passengers, be it catering, be it e-ticketing, be it rail near and rail-based tourism, which we are doing. So I don't see there is any challenge in that.
Just a couple of last questions in terms of the outlook, right? And where do you see the addition of new services heading into the end of the year and into the next financial year? And what is the implication for the revenue there?
You see, any investment by railway on coaches, on infrastructure, on line capacity enhancement, if you see the environment, what is our environment as on date where IRCTC is working? You see, both the DFC has come, so it has created a sparing of line capacity on main routes where the demand for passengers are more and more number of trains. Railway is already planning and investing into the coach manufacturing, and they have their own production plan, and more number of trains are likely to come in the coming financial year and the quarter going forward. So the business is there. Our challenge would be how to grab that business and improve our revenue and margin both.
Last question from my side, just trying to understand the tariff increases, if at all, were taken, Mr. Jain, during the quarter gone by.
Tariff related to what?
The services that you operate.
No, you see, and there is like we are into catering business, so we don't like ours is a licensing model where we get the license fee. So how our margin will improve, because we have already, like our licensees have already created and set up a chain of infrastructure based kitchens. Now on the same base kitchen there will be like adding of another train will give more business to them, then their fixed cost will get reduced. So all this will lead to a better volume and higher margin.
Mr. Jain, last question, and that has to do with the outlook on tourism. The objective of the government is to create these tourism hotspots in various parts of the country. How much of a benefit do you see your company getting from that in FY26?
You see, we are already seized with the government perspective, and recently we have run so many trains, tourist trains, and we have taken tourists to all these sports like Chenab Bridge. You see, we have already started our RTP for Chenab Bridge and we are getting passengers there. You see, northeastern part of India. So all these places where this infrastructure is created, we take the people, we take the tourists to those places through our both rail and non-rail based services.
Well, that was the management of IRCTC. The stock currently flat in trade, but it's the e-catering business that we should be watching out for. But let's shift focus to another management. Earlier today, we also spoke to Alexander George Muthoot, joint MD at Muthoot Finance, after company's Q3 numbers. Listen into that conversation as well.
When we started this financial year, we gave a guidance of about 15%. We crossed that in the first 6 months itself. Yes. And Q3 now we stand at about 29% growth. We are expecting good growth in Q4, but I cannot give you a specific number what it would be like. But we are expecting good growth in Q4, primarily because we are doing a lot of good new acquisition strategies to expand the category in the gold financing space. We have done a lot of things on the marketing front, on the digital front, and that has been testimony to all the new customers that we've added. Almost 13,70,178 customers, and to the tune of 15,723 crores have been dispersed. So our new customer acquisition strategy thrust remains. At the moment, with a loan book of more than 1,11,308 crores, we would give a estimate in financial year 26 of 15%. The book is large. The entire loan AUM has grown significantly. So as of now, we'll give a 15% guidance. We will definitely review it as the quarters progress and take a stance of if we need to revise it further.
Interesting one. So leaving it open to revision. So I'll change the texture of the question. What's leading to the kind of growth that you're seeing? On the one hand, you have the regulatory measures which are likely aiding you. The other side is asset quality also, where you've had steady asset quality, no real increase or spikes that we've seen, and therefore in terms of growth, what's driving the growth is what I'm trying to understand from you. Is it you taking market share from others? Is it new geographies? Is it new customers? What are existing customers doing? Are they topping up their loans given that gold prices have gone up? Just give us that perspective.
Okay. As a category leader in the gold financing space, we've always looked at expansion of the category. So with our huge branch network of over 7,000 plus branches, we always build an operational efficiency into our branch ecosystem. This year, our gold loan AUM per branch stands at 19.15 crores, which is up by almost 5 crores per branch across such a large distribution network. It's primarily because as a category leader, we believe to expand the category. And for expanding the category, we do a lot of marketing initiatives, which is building on the attitudinal transformation. India today has 25,000 tons of gold. Around only 1,500 to 2,000 tons has been monetized in the financial services sector, in the formal sector. So we, as a category leader, look at unlocking this dead asset and putting it to productive use. So to do that, a lot of educative series campaigns, attitudinal transformation campaigns, on-ground connect with the customers, catchment area activities with the customers in the branches is what our thrust is. It's not only about taking market share from each other, but it is about category expansion as a whole, which Muthoot Finance has always been doing and leading from the front. And that is where our thrust is. Like I said, the new customer acquisitions that we have done this year is a testimony to all the category leadership and category expansion initiatives that we have done on the digital ecosystem, on the branch network productivity, on the new customer acquisition strategy. So that is a thrust that we always have and will continue to do so because we feel there is a huge opportunity for the category itself to expand.
Okay. Talk to us about the other big moving part now, the 25 basis point cut on the repo. What impact does that have on your margins and how quickly?
So our NIMs currently is about 11.57%. We are expecting the NIMs to be around in the range of 11 to 12% itself. There has been a rate cut. So a few banks have passed it on, but we are expecting our NIMs to be around the 11 to 12% itself.
Okay. So how much would you pass on therefore?
It all depends, I think RBI has cut it by 25 basis points and, a rate cut for the gold demand, it is definitely going to benefit. And we always pass on these benefits to our customers. We are highly competitive in our interest rates that we pass on to the customers. And that's primarily the trust that they have in the brand, the kind of products and services that we offer at very competitive rates. We always give that benefit to the customer. So it all depends on what the cost of funds, how much it will reduce from the banks towards us, and then how much of that we pass on.
Okay. So on the other portion of your loan book, you have home finance, you have Muthoot Money, both of those growing at a very, very healthy clip. What's the thought process behind both of these verticals? Do you continue to grow them and scale them at the kind of clip you are, because you're well and you're adequately capitalized? So what's just the thought process behind these two verticals?
So our thrust, apart from our gold loan business, is to increase the contribution of our non-gold loan business by about 15 to 20% of the entire loan loan portfolio. We want to become a financial services conglomerate, and we deal with almost 2.5 lakh customers coming to us every single day. So there's a huge opportunity for us to cross-sell to these customers also, who have various diversified financial services needs. So these segments of financing, whether it's the personal loans, affordable housing loans, the Muthoot Money, which we have now converted from a vehicle finance company into a gold finance company. We have about 1,000 branches there. With the kind of expertise that we have, the kind of trust that we have with the customers, the kind of digital ecosystems with our customer relationship management module, and the connect with which we have the customers, we are effectively poised to cross-sell to this set of customers very effectively, because the trust and the bond with the customers has already been built over years and generations together. Now to build on new product categories is a much I think effective strategy for us, and we build on that cross-sell strategy through our existing distribution network.
And what about microfinance? Third straight quarter where you've degrown that book. When does it start to grow again?
So microfinance as a sector as a whole is going through a challenging phase. I'm looking at probably 2 quarters for things to settle down. We have a very good collection efficiency in Belstar, about over 98% efficiency that we have built. I think we have a self-help group that helps us build that collection efficiency also with the connect with the customers. So over a period of time, I think right now the GNPA of our Belstar stands at only about 2.91%, and we are taking proactive steps to strengthen the collections and improve the asset quality. So I think over the next 2 quarters, things should stabilize and we should be able to grow that back.
And is a lot of your provisioning, your whatever sitting in impairment, a reason for microfinance being the reason for that?
Come again, could you just repeat your question, please?
Is a large part of the provisioning that you've done over the last couple of quarters due to microfinance, and is that expected to continue over the next 2 quarters as well? Is that the trajectory we can expect, or will it spike up, go down? How do you expect that?
Okay. As you know, we moved to the Ind-AS since accounting system 2018, and we are required to make provisions as per the principles laid down in the Ind-AS with the expected credit loss, ECL provisions that we have done. So the impairment has gone up because of 2 reasons. One, on account of higher level of gold loan growth that has happened during the quarter of 7,290 crores. The ECL provision on the stage 1 and stage 2 standard assets have gone up. On account of increase in stage 3 NPA assets, that's about 237 crores. So ECL provision has also gone up accordingly. And as you are aware, in gold loans, the NPA assets will not incur losses because of the collateral being gold jewelry. But being an accounting regulatory requirement, we have to consider NPA and accordingly have to make provisions. But the gold loan ECL provisions will not translate into actual losses. Hence, the same can be treated as a book entry. Once the NPA levels is reduced, ECL provisions can easily also get reversed accordingly.
Very optimistic commentary that we are seeing from Muthoot Finance. In fact, the stock is up over 6% in trade today. But another stock which is in focus after their Q3 results is ITD Cementation. After they have reported 11% of a revenue growth here, while the 9-month FY25 revenue growth stands at about 21%. To discuss the outlook forward for the business, we were joined in by Prasad Patwardhan, the CFO of ITD Cementation. Do listen into that slice of conversation as well.
Well, this performance is in line with what we have been indicating earlier. So, while on a quarter-on-quarter basis or a year-on-year basis, we have grown by about 12-13%. If you look at our 9-month numbers, the top line has grown by about 22%, and the profit also has increased significantly. So, all in all, it has been a healthy performance from us, and we hope to continue to replicate this performance going forward.
Mr. Patwar, then while the Q3 we have seen a 11% growth, it's the previous few quarters wherein you had reported a very strong set of numbers. Well, if you look at the 9-month picture, it's 21% of growth that you have reported. Want to understand your sense from FY26 onwards. What is the type of revenue growth that one should be looking out for the business, and what are some of the key levers which would support this growth?
Well, given the fact that the government continues to focus on infrastructure development, and we are pretty hopeful that the private sector capex will also pick up, the outlook that we see for the next financial year and going forward is pretty good. We expect a lot more projects to come up for tendering, and that will help us to grow our business. The order book is expected to grow, and I'm sure our growth next year is likely to be higher than what we are doing in the current year.
So higher than 25%, is that the correct assessment? Also along with that, I want to plug in the margin question as well. Now in this quarter, we have seen an uptick in terms of where the other expenses and the subcontracting expenses are. Want to understand from you the margin picture as well forward. Will it be sustainable in the 10% range, or should we expect a further uptick in terms of margins as well?
Well, we are working towards the gradual uptick in our margins, but as I said, it will be gradual. But we hope to cross 10%, and our endeavor and focus is going to be on margin improvement going forward.
Any key growth levers that would support this margin improvement? Are there any particular segments that you have which would support a higher margin profile as compared to the other segments which are there, or any kind of operational advantages that you're looking forward to?
Well, in the past, we have seen, orders in the marine segment or the underground metro segment have been delivering better margins. So we will continue to focus on these segments. So largely, we focus on 4 or 5 segments where we have the expertise and the experience of executing projects, and that will help us to improve our margins going forward.
Okay, so margin uptake as well as revenue growth is something that should be looked forward for ITD Cementation. Now coming to the order picture, in 9-month FY25, if you look at the orders, that stood at about 6,370 crore, which is about a 4% of growth. Now in the earlier con call, you had endeavored to cross a 10,000 crore of target in terms of where the new orders are concerned. So this would be a heavy Q4 for the business in terms of where the new orders are concerned. So are we on track to achieve this guidance in terms of new orders, and if you can give us a sense in terms of execution as well for the business?
Well, we have submitted quite a few bids in the last few months, and we expect some of them to open in the next 1 month or so. So we are pretty hopeful of improving on our order book before the end of this quarter. The quantum will be difficult to pinpoint at this stage, but we have a few projects on our radar where the tenders are going to be opened, and that should probably add to our order book in this quarter. In terms of revenue growth, we have seen the 9-month numbers. We are on a 9-month basis, we have reported 20% growth in top line, and I think we'll continue to do that in the current year. And as I mentioned earlier, with the government focusing on infrastructure and the private sector capex also likely to pick up, we could see a further growth in our top line in 25-26 and going forward.
So Mr. Patwar, then considering the bidding opportunity which is there, can you quantify currently for what is the bidding opportunity looking like, the quantum of it, and what usually for a business like ITD Cementation is the conversion or rather the success ratio in terms of how much you've bid for and how much these gets converted into the orders?
Well, the total project pipeline, projects where we have submitted bids or are in the process of submitting bids, in terms of near-term visibility, we have about 40-50,000 crores of orders that we are looking at. And typically the conversion, what we have seen in the past, it averages around 15 to 20%. It has gone up to 25-30% as well. So the timelines and the conversion factor is not really something in our control. But given the past track record, these are the numbers that I can share with you at this stage.
And in any particular segment that we are seeing more orders coming in from, because if we look at the order book mix, you have mentioned maritime structures, which has currently it contributes to the highest mix for the business, about 36% here. And as you've mentioned that there are also higher margins in the business. So if you can just give us an update or rather perspective on the same about this as well.
Well, you're right. Marine has given us better margins in the past, and there are quite a few projects, not only in India but overseas as well, where we have submitted our bids for marine projects. Similarly, underground metro projects, we have submitted our bids or are in the process of submitting bids very soon. So there is visibility on the order flows in these segments, and hopefully some of the orders will come our way, which will help us to improve our order book and performance going forward.
Well, that was the management of ITD Cementation, but that's all the time that we had on this show. Stay tuned to NDTV for lots more lined up on the other side.
Entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your
Hello and welcome to NDTV Profit. A very good afternoon to all the viewers. You're watching Profit Buzzers. I'm Hiral Datia and with me is Varsha. Varsha, clearly good afternoon, and markets have been at an inflection point today. You're seeing some good moves coming in. We're almost about to go to that 23,200 mark in today's day of trade. We're nearly at the day's highest levels. Sustainability and sustenance is going to be key in terms of the second half of the trading session as we speak. But right now, 23,190. We did go above the 23,200 mark. From here on, what's going to be the next level that we should be tracking is going to be interesting to watch out for. The income tax bill is going to be crucial as well. So let's see what comes out of that and if any impact sentimentally that could be coming in on the markets. But let's quickly pull up Bank Nifty on the screens and see what that is doing in trade. There you go. We are nearly at the day's highs, not there, but 49,726 is what we are trading at, 100 points away from the day's highest levels in terms of Bank Nifty as well. Let's look at the sectoral performance because it's an interesting day in terms of today's session. So clearly, except IT, all the other sectoral indices that are trading in the positive, with Pharma leading the pack, followed by metals, real estate, consumption, media, as well as energy. IT, a downer, but just 0.3% lower in today's session because IT was an outlier in yesterday's session. So some bit of profit booking that's coming in today's day of trade with regards to where IT majors are concerned. Apart from that, let's just quickly pull up the individual stocks on Nifty 50, what that heat map looks like as well in today's session. What's gaining in today's day? You have a Tata Steel, the top gainer today with gains of 3.8% coming in with regards to where Tata Steel goes. But if you see in terms of contribution, you do have a Bajaj Finance, Reliance Industries, ICICI Bank and a Sun Pharma which are contributing to gains. But Infosys, TCS lagging the trend. You have Tata Steel, which is the top gainer today, Bajaj Finance, JSW Steel, Cipla, Bajaj Finserv. On the losing end, you have Adani Enterprises, Infosys, Hero Motor, TCS, as well as a Wipro. So that's what it's looking like in terms of where benchmarks as well as the large cap space goes, Varsha. Interesting trends in the broader markets as well because that's where the route has been. That's where the focus has been with a lot of fund managers who are coming and now giving their views as to what one should be doing with the kind of meltdown that we've already seen.
Absolutely, Hiral. And the interesting thing is, if you look at the Nifty mid cap 150 is up 1.4%. That's a gain from the low, and now if you see it's up almost 1.2%. Now let's see who are the gainers when it comes to Nifty mid cap 150. You have Jubilant Food, you have Muthoot Finance on the back of good earnings, you have Vodafone and also SBI Cards where Macquarie had upgraded their rating, and even Godrej Properties, if you see, is on the gainers list. While on the losers list, if I were to talk about, you have SKF, you have PI Industries. Well, few days back, PI Industries did come with their numbers, and the numbers were not that good. Even they had actually reduced their guidance, and then you have Timken also on the losers side. You have Minda and ZF Commercial. While if I were to talk about Nifty small cap 250. So there also it's up almost 0.7%, and the gainers you have Suven Pharma. Well, very good numbers from Suven Pharma on the back of CDMO business that the company did. Then you have Jai Balaji, you have Honasa Consumer. Honasa company swings back into profitability. Revenue was in line, EBITDA and net profit was a beat. Phenolics Cables is also one of the counters in gainers. And Godrej Industries is buzzing on the back of earnings. The stock was up almost 6% in trade today. There you go. It's almost 5% up. Then on the losers side, if I were to talk about, you have Natco Pharma, very weak earnings. This is on the back of their drag which had in their export formulation business, which is a high margin business. So because of that, you have the margins have also dragged, and the stock is down almost 18%. Also FDC, if I were to talk about, again weak set of earnings by FDC. Vijaya Diagnostics yesterday came out with the results, even had a con call details also. And lastly, if you see, the Godavari Power is also on the loser side. When it comes to Nifty small cap
right,
250.
So interesting names that we're picking up so far, but clearly 43 advances, 7 declines on Nifty 50. And before we shift focus on the buzzing stocks of the day, NDTV Profit spoke to Dimensions Consulting's Ajay Srivastav and Quant Mutual Fund's Sandeep Tandon. Here is what they had to say on the ongoing correction in the market. Let's first listen into that conversation.
The answer is, to your answer is, I think we are in oversold territory at this point of time. Having said that, I think we need to be cognizant of the fact that a lot of companies did not give results in line with the expectations. So how they do the work for the next quarter is going to be very important for us. And the fact remains that this time around, as the March ending comes in the next 45 days, there will be a lot of rebalancing on the side of tax as well, liabilities. People who book profits may want to sell out the shares with their losses to balance their tax, etc. So it's going to be volatile the next 45 days. Definitely it's going to be. But I think definitely on the side that selling is kind of abating, at least in a small and mid cap was a local selling. It's not, you can't say FIIs was selling mid caps and small caps. That's not true. So there was serious profit booking happening in the system. Having said that, if I were sitting on a portfolio, would I sell now? The answer is broadly no, unless something really bad happens to your company. Would I buy seriously? The answer is perhaps again no, because, that's it, 45 days, volatility, RBI out of ammunition, Trump where he is today. I think this is going to be a time where you wait patiently for times to come and you buy. But I think market bottom, perhaps for the short term, definitely yes. So you don't need to sell if you're really worried about, in our view, about that more damage can happen to your portfolio.
We have corrected for nearly, when I'm talking about not the market correction, I'm in terms of risk appetite data points of view or some of the macro data we look at, it has deteriorating or corrected a lot from last 9 months. I think we think, as per our understanding of risk matrix, we think we have covered 60% of the journey. Okay. Now, nobody has bought virtually at the top of the cycle and nobody has sold at virtually at the bottom of the cycle. Okay. So what we are looking at, that this time has come where most admired territory stocks are now trading in neglected zone. Multiple stocks in large caps are in neglected and, neglect sort of phase is there. I think some of these names have bottomed out, which means selective buying opportunity is definitely there in the large caps in particular. And now in last few weeks, the way small and mid has butchered, I think we are still remain cautious on the mid cap space because they're still very expensive. And if I have to say the number of quantities also right from Nifty 100 to 250, so only 150 stocks. So the scarcity premium which was there in the past, I think that needs more correction. But I made a statement on small cap. Yes, we are buyer in small cap because we think many names have now trading in the neglected zone. So selectively I'm buying. See, I will not able to, as an institution, the size which we buy, we will not able to participate virtually at the bottom of the cycle. So if we believe that 60% of journey is largely over, and I still expect that maybe end of March, beginning or mid of April sort of thing, this cycle of risk of which is playing out should peak out, which means select buying opportunity has come. And this is exactly what we are doing, because if you recollect, we were sitting around 20% cash few months back. So it's a great opportunity for us to deploy money. And this is something what we are doing very selectively.
Yeah, so, but moving on, let me just welcome Avinash Gorakshakar, who's the Director of Research, Profit Mart Securities. Welcome, Avinash. So, before, let's look at our theme first, which is pharma stocks. So pharma stocks are actually buzzing. If you can pull out, Aurobindo Pharma is up, then you have Cipla, Sun Pharma. All the pharma stocks are buzzing. Now there's a reason behind that. The US President Donald Trump, if you see, have announced plans to impose reciprocal tariffs on countries that charge duties on US imports. Now, Trump might consider exceptions for certain industries such as automotive and pharmaceuticals. Now, this is a big news, because this is good for Indian pharmaceutical companies that export to US, and that's the reason why Indian investors are actually cheering this news. And while while the US market, if you see, making up a huge chunk of sales for several Indian drug makers, fear of increased tariffs on exports to the country had sent investors on the cautious footing, and that's the reason few days back all the pharma counters were trading in pressure. But now, because of this news, all the pharma companies, if you see, are actually in up. But if I were to talk about the key stocks in focus and how much US contributes to the overall revenues of these companies, you have Aurobindo Pharma, almost 46% of revenues comes from US. Then you have Cipla, which has 28% exposure to US. Then you have Lupin, Dr. Reddy's, Sun Pharma, Torrent Pharmaceuticals. So a lot of pharma companies are actually in focus. But If I'm speaking about pharma companies, in fact, we caught up with Ramesh Swaminathan, who's the Executive Director, Global CFO and Head of API at Lupin, talking about their growth outlook for the coming quarters. Listen in.
The overall margins could reflect a much healthier number if you were to knock out the impact of adjacencies which are still making a loss at this stage. So I would be very happy to state that the emphasis on higher margins is certainly on, and you would see better results coming in the quarters to come. Clearly, we have moved up. So we have this year it's in the 22.5 to 23.5 range, so to speak, and clearly we believe that that's the way it would be for the next couple of years also. Though I expect, in fact, the margins to creep to about 25%, thanks to all of these initiatives, plus of course the adjacencies also blossoming into more profitable units. Clearly, the trend will continue.
Avinash, let me come to you on Lupin first, and then we can discuss more. So Lupin, if you see, good set of numbers. Though India revenue, they were expecting much more revenue, but due to respiratory pressures, the India revenue was not that good according to them. But overall, they had so they are expecting double-digit growth for next 3 years. They're expecting double-digit growth when it US. But what are your views when it comes to Lupin? The stock is up today as well.
Yeah, I think so. Parcha, I think numbers from Lupin have been much better than what the street expected. I think, yes, the domestic market sales were not up to expectations, but if you look at the US market sales plus the rest of the world revenue kind of growth, I think clearly, I think Lupin has outperformed. And I think looking at the management commentary, my sense is that at least for the next 1 or 2 quarters, revenue visibility seems to be pretty solid. And the margins are definitely going to get better. As far as your question earlier on the tariff side was concerned, I think, yes, India could be a beneficiary because, companies which are large exporters to the US, I think clearly this could be an exception where, sectors like pharma could possibly get a little breather in this tariff war. And in that perspective, I think, the larger players like Lupin, Sun Pharma typically, or even though, these are players which fortunately there has been no major regulatory FDA issues. So I think if this continues, then I think you're going to see a much stronger year for FY26 also. So net, I think Lupin definitely is a stock worth looking at. I would definitely, look at buying into the stock if there's a mild correction. The stock has definitely gone up post the results, but I think looking at the next 12 to 15 months kind of time frame, it could be a good addition to your portfolio.
Okay, so you are actually bullish on Lupin, but sticking to the pharma sector only, 2 stocks which are not doing well. One is, Orchid Pharma, wherein if you see the numbers were not actually good, though there was a revenue growth of 20% year on year, but the price corrections, in major products have led to overall muted sales figures for the company. And their AMS division, which company is actually bullish on, is in investment phase, contributing to a negative EBITDA of around, 6.4 crore. And the price corrections has what led to the muted growth, and the 7 ACA project, although assurance were given that there would be a PLI, the government will extend a PLI scheme, but that's under concern right now. So these are the whole lot reason why Orchid Pharma is under pressure. The other stock which is again under pressure is Natco Pharma. If you see very weak set of numbers, the stock is down almost 18%. Now the US export formulation have degrown 52% year on year. So one concern is the majority business for Natco Pharma comes from the US formulation, and that is down year on year, and that being a high margin product, now because of that the margins have also declined. So these are the major 2 counters which is under pressure. Now Avinash, your view on both the counters, Orchid and Natco?
So I think both counters, Varsha, I think looking at the kind of performance in the latest quarter, our sense is that unless we get some better clarity from the management as to what the growth momentum could pan out in the next few quarters, I think it's a very difficult question to point out that how earnings growth could come in FY26 also. But as far as Orchid is concerned, I think Orchid is still into an investment phase. The markets are still awaiting for positive EBITDA numbers, from their new investments, which I think will take a little bit of time. So probably from the first half of FY26, you could get some visibility which could, trickle down into positive EBITDA numbers. As far as Natco is concerned, I think it remains vulnerable to the US markets, and with such a steep fall in their US revenues, I think clearly the March quarter is also going to be equally challenging. So I think it's better that investors obviously whoever have made decent money here should take some money off the table, and fresh investment should be considered only post the March quarter, because after that there could be a little bit clarity on the business and on the growth prospects going forward.
Right, so interesting comments coming in. Thank you, Avinash, for that on Natco, Pharma as well as Orchid. But moving on, shifting focus to the consumption theme, you have Macquarie, which has gone ahead and initiated coverage on 3 counters. That's Lemon Tree, Chalet and Indian Hotels. Somit joins us to tell us more. Somit, what is the brokerage talking about now?
Well, yes, Macquarie has come out with this big note on the hotel industry. I'll start off with the company in which has the highest return potential based on Macquarie's target price, and that is Lemon Tree. They have initiated an outperform rating with a target price of 210, which suggests a return potential or potential upside of at least 60% from here on. Now, they're saying that Lemon Tree is driving hotel penetration in mid-market and Tier 2 and Tier 3 cities in India. They're saying that the company has an asset-light business model, which helps them generate high free cash flow. And apart from that, they're also saying that the company will benefit from the increasing demand on growing business, leisure travels and the discretionary income that will come in towards the Indian consumers on the back of the tax benefits that were recently announced in the budget. Now, they're expecting the company's return on capital employed to expand to nearly 24%. That is double of what the current rate is at around 12%. And they're saying that Lemon Tree stands to benefit from the tourism push in FY26 and the recent tax cut. The second company is a Chalet Hotel, where they have initiated an outperform rating with a target price of close to 1100 rupees, which suggests a return potential of at least 55% from here on. They are saying that Chalet is a licensee, developer and operator of premium hotels and real estate in India, which is focused primarily when it comes to Tier 1 metros. They are saying that the business will benefit from the increased business demand and shortages of inventory in the Tier 1 cities. They are also expecting the company's top line and EBITDA to grow at a CAGR of nearly 20% and 23% over the next 3 financial years. And lastly, it's on Indian Hotels, where they have initiated a neutral rating with a target price of 840, which suggests a return potential or potential upside of at least 10%. They are saying that Indian Hotels brand and expanding portfolio of businesses should provide sustained and steady growth for the company. They are expecting the company's revenue and EBITDA to grow at a CAGR of nearly 17% and 20% respectively over FY24 to FY28, but they have a neutral rating because they believe that the risk reward at current prices are quite balanced, and hence it's a neutral rating on Indian Hotels and an outperform rating when it comes to Lemon Tree and Chalet.
Thanks, Somit, for the same. Stay with us. Avinash, between Lemon Tree, Chalet and Indian Hotels, where would your bets be? Because you have 2 outperforms and the neutral coming in on Indian Hotels by Macquarie.
No, I think the overall hospitality space here is going to do exceedingly well. I think even in the third quarter this time, ending December, I think we saw very strong numbers, from almost all the hotel companies. And in that respect, I would suggest that, all the 3 companies look promising. But I think our choice bet would be Indian Hotels, which is the market leader. They not only enjoy a very strong geographical presence, but the highest room inventory. And I think despite the fact that it's priced fair to expensive, I think, looking at the kind of strong brand pull and the kind of ARPUs which they've got, room rental which they've got, I would not be surprised that FY26 also should be a lot better. The next candidate which we like is something like Lemon Tree, as rightly pointed out, that in the affordable hotel space, they have been growing very aggressively. The only point of concern and the caveat is that the company has a very, large capital expenditure program. I believe that, this is not an asset-light business, as was told. The company has to invest a lot even in their own properties. And of course, they have some arrangement with some other hotel groups also. But I think overall, if one were to take the next 12 to 18 months, I think Lemon Tree can definitely be a good risk-reward bet. But Indian Hotels definitely deserves a premium. So we are positive both on Indian Hotels and Lemon Tree.
Both of them on the positive list of Avinash. Somit, that you're still with us. The other 2 consumption stocks that are in focus today is the Jubilant Foodworks, which is trading in the positive, and a Honasa. Jefferies has come up with their reports on both these counters as well. What are they saying?
Well, yes, both the counters are buzzing in trade post. They reported their Q3 numbers. Now, Jefferies has maintained their buy rating on Jubilant Foodworks with a target price of 1,000 rupees. They are saying that the India same-store sales growth has come in at double-digit on the back of the management's focus on growth. However, this double-digit same-store sales growth has come at the cost of margin, but they are not too much concerned about the margins at this point of time because growth is coming for the company at a higher rate. They're also saying that the upcoming analyst meet that the company is doing for the first time would be important to track because they would want to get more clarity from the management on the growth plans and margin revival going forward. They also say that Jubilant remains their best retail and discretionary pick currently. When it comes to Honasa Consumer, they have a buy rating. Jefferies has a buy rating, but they have cut the target price to 320 from 360. They are saying that the numbers were pretty much in line with what the street was expecting. The EBITDA beat, EBITDA was a slight beat compared to what the street expectations were. They're also saying that there were no nasty surprises in the third quarter as we had seen in the second quarter. Mamaearth as a brand has been declining, but that is what the company had also indicated. But the younger brands, which contribute nearly 40% to the top line, have been growing at a stable rate. They also say that that Honasa Consumer remains a high risk, high reward buy for their clients. And apart from that, IFL also had come out with this note on Honasa where they had upgraded their rating to buy with a target price of 280 rupees. They also believe that the risk reward is much more favorable for Honasa at this point of time.
Right. Thank you so much for all the details. Avinash, Honasa and Jubilant, which one you like?
No, I think Jubilant definitely deserves a second look, and I think in this challenging period, they've done a decent kind of performance. I would not be surprised that you could see a little bit of re-rating on the stock even further, considering the fact that it enjoys a very strong geographical network, a very strong brand. Honasa, on the other hand, I think we would like to at least wait for a couple of quarters before we see a very strong revival in the business. Overall, I think this company has an issue with their branding, and I think earlier their strategy of going for for the kind of marketing network, the branding initiative did not work out. So I think the kind of premiums which the company collected from shareholders, I think still needs to be justified in terms of earnings growth, return on equity. So, we are more positive on Jubilant. I think Jubilant definitely, if one were to look at the next 12 to 15 months, we believe that the revenue visibility and the profitability traction should continue to do well.
Right. So that's with regards to Jubilant Foods. But moving and shifting focus to another stock that was on everyone's radar was a Kotak Mahindra Bank. And this is after the RBI actually went ahead and actually they lifted the supervisory restrictions on the bank. In fact, this will actually allow them to resume onboarding new customers as well as issuing credit cards. My colleague Vishwanath Nair joins us. Vishi, clearly, this was something that was in the offing. Yep. The timeline was what people were anticipating.
Correct.
To be slightly longer, but it's come in earlier than that 12 to 15 months, if I'm not mistaken, right?
Yeah, so the fear was that it would last 12 to 15 months, but it has gone on to about 9-10 months odd, and now finally the restrictions are removed. If you were to look at where Kotak Mahindra Bank was before, due to the restrictions which came in April 2024, so that's the beginning of the financial year, since then they have lost a lot of momentum on customer acquisition. They've also lost momentum on credit card issuances, of course, because they can't issue any fresh credit cards. So just a quick look at the numbers. Between FY23 and FY24, the total number of customers have gone up by about 90 lakh. That was a 22% growth. But between March 31st, 2024 and now December 31st, 2024, that number has only gone up by about 20 lakhs. So that's about a 4% increase in the 9 months of this financial year. So you're clearly seeing that momentum slowing down. Similarly, on the credit card portfolio as well, there's been a significant drop. The portfolio has not gone anywhere, sticking around close to 14,000 odd crore. It was 14,500 at the end of March. So these things are going to now take off. Hopefully, the bank will be able to capitalize on these restrictions being removed. They can push up customer acquisition. They can push up credit card growth. What is also interesting is that in these 9 months, the bank has themselves talked about pushing up cross-sell businesses. So they have been capitalizing on that, which hopefully as more customers come in, the capitalization of that business will go up and they will be able to ensure better cross-sell, better fee income from these customers. All of this is going to help. So far, the financial impact is about 450 crore according to the bank because of these restrictions. That stays as is. So we need to see what happens in this last final quarter. About a month and a half they have to actually turn things around. If they're able to cover that loss, if they're able to grow their business significantly, which will aid them in stabilizing their financials.
This is going to be interesting, and I think the stock is, pre-open was up almost around 10%. It stabilized at around 2.5% as we speak right now. But I think this was something the markets were already pricing in, because in the last 1 month, the stock has already gained around 14%, right? So I think there was some bit of anticipation that did come in on this one. Avinash, your quick view with regards to Kotak Mahindra Bank, the overhang with regards to onboarding new customers and issuing new credit cards, that's gone away now. What would you advise investors to do?
No, I think definitely some positive news coming in for Kotak Bank. And I think, this is definitely going to propel growth faster in the coming few quarters. I think we could see FY26 panning out to be much better, because obviously this overhang was there for a long time. So I think we are pretty positive that this will help the bank to record a stronger growth compared to last year. And I think, that has already been discounted partially by the markets. But I think for numbers to get crystallized into earnings, I think we'll probably have to wait for the April to June quarter. But I think net, this is positive. And I think it should definitely trickle down to a better earning number for FY26.
Right, so that's with Kotak Mahindra Bank. Apart from that, from the banking space, you have ICICI Bank also that is in focus. And this is because their JV partner, Prudential PLC, is planning to list its EMC unit. Now, ICICI will remain a majority stakeholder, is in fact a majority stakeholder as well in ICICI Prudential AMC. So that is one of the companies that we should be looking at as well. 0.5% up move is what we are seeing in terms of ICICI Bank. Very quickly, Avinash, your view on the back of this. Do you think this would be good value unlocking for ICICI Bank as well?
Yeah, I think, Hiral, this definitely will be good value unlocking, because, this AMC has been profitable, has been run very well. And I think this is one of the top AMCs in the country. So typically, investors would obviously like to encash on this opportunity. And I think valuations for this AMC would definitely be at a decent premium, which eventually would definitely help, ICICI Bank, which is the holding partner here. And obviously, financial service intermediaries are definitely in demand, considering the kind of, offerings which are coming in the capital market, plus the interest from mutual fund investors. So I think net, it's a big positive for ICICI Bank.
Right, so big positive coming in for an ICICI Bank as well. Avinash, stay with us. We'll quickly slip into a short break. On the other side, lots more topics that we will be discussing, and we will be joined by Osho Krishnan as well. Please stay tuned to NDTV Profit.
Entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Sources telling us is that government is expected to provide a roadmap of the next phase of national monetization pipeline, where they are going to set a higher target for the next fiscal onwards.
Building on the success of the first asset monetization plan announced in 2021, the second plan for 2025 to 30 will be launched to plow back capital of 10 lakh crore in new projects.
And welcome back to Profit Buzzers. Well, before moving on to our key themes or future themes, just wanted to invite Ashok Leyland, who is a senior research analyst, technical and derivatives at Angel One. Welcome, Ashok Leyland, to the show. But I was just speaking about the chemical sector. So few of the counters have actually came out with its numbers. Let me just start with Balaji Amines, which has came out with Q3 numbers. If you see overall weak set of numbers, the total volumes, which is actually very important or a key parameter for Balaji Amines, is down almost 10%. And this is what has led to revenue decline of almost 18% for the company, and EBITDA is also down 38%. And margins were 15% versus 19% last year. And because of all these things, the net profit is down 33%. But they are on track when it comes to their new expansion of 750 crores in the subsidiary Balaji Specialty Chemicals. But overall, we are seeing the kind of pressure that the chemical industry is going through. Balaji have given a very, very weak set of numbers, and this is the reason if you see the stock is down almost 2%. The other counter which is in focus is IOL Chemicals and Pharmaceuticals. Again, if you see weak set of numbers from this counter as well, the stock is down almost 0.2%, not that down, but overall weak set of numbers. Now why? If you see the revenue was flat. This was led by pricing pressure and the stagnant demand that the company has seen. Though EBITDA went up 6%, margins were at 9% versus 8.5% last year, and net profit was down almost 11%. But the flat revenue, the pricing pressure that the overall chemical industry is going through, and the stagnant demand this company has seen has led to overall weak set of numbers. But let me come to you, Mr. Osho. So Balaji Amines and IOL Chemicals, both the counters are under pressure. So how are the charts looking like?
Very good afternoon to both of you. Well, looking at the technical perspective of Balaji Amines, then this counter has seen a very strong correction in the recent period. If I have to quote, then in the month from the month of October, there has been relentless sell-off in this counter, and recently it has breached a very strong support zone of nearly 1980. And from there onwards, again, there has been no respite from the selling in this counter. And overall, on the technical front, this counter is looking very weak. There has been no pullback, no respite in this counter, and the short-term moving average has been witnessing a kind of a resistance for this counter. So until it covers or until it breaches above the zone of 1750, conviction lacks in this counter, and one should stay sidelines from Balaji Amines. Particularly, this counter is looking very weak on the technical front, and better not to get into bottom fishing for this counter at current levels.
Got it. So, no, I mean, not for Balaji. I mean, so the charts is not looking good. But Avinash, speaking about the fundamental analysis of this, so Balaji is actually, doing a lot of capacity expansion, going into, high margin products, and company, the management, though they have not walked the talk, but they've done, I mean, they've came and said that, they're seeing high growth trajectory, when it comes to next 2 to 3 years. How are you viewing this counter?
No, I think, Varsha, numbers need to do the final talking, as you rightly mentioned, that, markets are not getting comfort on the sense that the narrative is clearly spelled out by the company management, but, earnings numbers have yet not got reflected. So I think, we'll have to probably wait for the March or maybe the June quarter to get a sense of how whatever management has strategized actually gets converted into earnings, because markets are not going to like these kind of earnings disappointments for a long time. And the stock is not cheap by any standard. So, if the company does not deliver for the next 1 or 2 quarters, then I think the markets are not going to, leave this company at the current valuation. You could expect a lot of de-rating before, the stock starts moving up again. So I think it's better to wait for the numbers to come in. I think the March quarter will be a crucial quarter. If at all there is any earnings improvement, then I think we could see the overall improvement in the EBITDA, in the volumes, in the product mix, which I think would be very crucial to watch out to, to make a call whether what the management is mentioning is actually getting reflected in the numbers.
Right, thanks, Avinash, for the same. In fact, you have Ipca Laboratories, which has just reported numbers. The top line is up around 9 to 10%. That number is coming at 2,245 odd crores. If you see in terms of the profit number as well, I think a 39% uptick is what I'm picking up from the ticker. So around 450, 460 odd crores is what that number has come in at in terms of the bottom line as well. Let's just quickly show the charts of Ipca Laboratories and see what the stock is doing in trade. In the meantime, you'll have Varsha who will get us more because she tracks the company pretty closely. 4.5% up move. It has cooled off slightly from the day's highs of 1500, but currently we're just 20 points away from that. Varsha, overall in terms of Ipca, anything that you were expecting for this counter?
So yes, Hiral. So basically, Ipca's management was very bullish when it comes to growth trajectory, and their projection for FY25 were estimated when it comes to revenue growth was 9 to 10% for overall FY25, and the revenue was up around, I guess, 9 to 10% only. But they had actually revised their expectations in last quarter from 12% to 10%. One thing is that, but recently they had acquired Unichem Lab, if you see, and management was really optimistic when it comes to achieving synergies from Unichem acquisition with the anticipated cost reduction in API processes and of course procuring benefits.
In fact, and to add to what you're saying, the formulation domestic business has seen a growth of around 13% on a year-on-year basis. Exports, again, the branded part is a 53% growth. Generics has seen a degrowth of around 11%, and institutional has seen a degrowth of 3%, but institutional is still a small portion of exports. It's the generic business which is, I think, the key, 11%.
Because, when it comes to pharma counters, you have pricing erosion or pricing pressure that is taking place, and that's the reason, the generic business of all the pharma companies are taking a hit. But overall, so Ipca is actually expecting synergy synergies when it comes from Unicap Lab, and also they are going into few of the launches which will help company to grow. But yeah, generic business for overall pharma companies is one concern that every pharma companies is going through.
Right. In fact, margins have been absolutely strong. 20.6% versus the 16.1% is what we're picking up. In fact, Osho, what are charts indicating? What would you advise investors to do with Ipca Laboratories, seeing the strength the stock has been seeing, at least in today's day of trade?
See, overall, Ipca Labs has been seen a very strong retracement of nearly 50% of the low, from the lows of nearly 1100 towards the higher zone of 1750. And from there onwards, we were witnessing a kind of a consolidation from the last 3 trading weeks in this counter. But overall, looking at the setup, this counter has retracted very strongly from the 50% Fibonacci retracement and is expected to continue its upward momentum. So I'm expecting that in the coming period, there is a possibility for this counter to retest the zone of 1600, 1620 odd levels. Those are a crucial resistance zone for this counter. If it breaches above 1620 on a decisive manner, then we can see a decisive continuation towards the 1750 kind of a zone. While on the lower end, the 200-day EMA hovering around the zone of 1720 or 1420 or 1400 odd levels is expected to provide very strong cushioning to this counter.
Right, that's with regards to Ipca Laboratories. But apart from this, a lot of other earnings that have been strong. Godrej Industries posted a strong set of numbers. Muthoot Finance is another one that we've been focusing on as well. In fact, my colleague Mika stands by to get us more in terms of the other mid-cap companies that are buzzing on the back of numbers. Mika, over to you.
Yeah, I'll start with Godrej Industries. Intraday high of almost 10%. A good set of numbers. You've seen revenue uptick of 34%. EBITDA more than double. Margins have improved to 12.4% versus 7.8%. And net profit is up 77%. Now, the top performing segments as per revenue, one was the estate and property, that's 124%, that's your Godrej Properties. Finance and investments saw 55% uptick in revenues. The chemical segment saw 44% uptick, and veg oils revenues rose 40%. EBITDA was also helped by the higher revenue growth, a 31% fall in the stock and trade purchases, as well as an inventory reversal of 2,900 odd crores. Then we have Muthoot Finance, intraday high of 7%. Their net interest income was up 42.8% on a year-on-year basis, and net profit was up 32%. And their loan assets under management also saw a 34% increase on a year-on-year basis to 1.11 lakh crore. And lastly, we have SKF India on the other side, intraday low of almost 4%. EBITDA and profits have missed estimates. Despite revenue uptick of 15%, we've seen EBITDA come off and fall 30%. Margins have contracted to 9.7% versus 15.8%, and net profit is down 17% at 109 crores, missing the estimate of 154 crores. In terms of what hurt earnings and the EBITDA and margins despite the revenue uptick, one is a 56% rise in stock and trade purchases, a 15% rise in their material costs, which is their highest amount of costs, and the 13% rise in their employee costs as well.
Right, thank you for getting us the details, Mika. Avinash, coming to you. SKF, major impact is coming in terms of where the operational front goes. Whereas Muthoot as well as Godrej Industries, both of them have given out a strong number. What would your advice be? Where would your bets be out of the three?
No, I think clearly Muthoot Finance will be an outperformer. I think if you look at the rise in gold prices, I think there's no stopping for the gold price upward trajectory. My sense is that we could see higher levels for gold, and that definitely would actually make the business more stronger for a player like Muthoot Finance, which is a very large player in gold finance. And best part is this business is extremely profitable, has very little risk, because gold as an asset class has hardly any chance of going bad. Most importantly, I would believe that Muthoot has got a good amount of scalability potential, considering the fact that post-COVID now normalcy has come in, and we could see higher levels. So levels of around 2550, 2600 look very much possible, despite the fact that today the stock is up in today's trade. Our sense is that any dip should be used to accumulate the stock. I would say that on the other two companies, specifically SKF India, I think has been a underperformer largely because of the downturn seen in specific segments like commercial vehicle and passenger cars. And most importantly, input prices have also gone up. So I think they were not able to pass on the increased cost pressure to the customers. So this actually impacted their margins. But I think, yes, on lower levels, SKF definitely is an MNC player, is a very large player in the bearing space. So once the automobile sector starts moving up and actually starts showing positive growth, hopefully from the April to June quarter, I think you could see a little bit of stability on this counter. So longer term, yes, any decline should be used to accumulate the stock, but only from a long-term perspective.
Got it. And Mr. Krishan, your views when it comes to Godrej Industries and Muthoot Finance, how are the charts looking there?
See, firstly, for Muthoot Finance, the charts are very positive for this counter. There has been a cycle of higher highs, higher lows formation, and the short-term moving average, the 20 and 50-day exponential moving average, is providing a very strong cushion to this counter. So any dip towards the zone of 50-day exponential moving average is an opportunity to accumulate or to even aggressively buy this counter. Overall, the trajectory remains very positive. One should wait for some kind of correction because today already the counter is nearly 6.5% higher. But overall, the perspective and the outlook looks very positive. If someone is already holding, it is advisable to hold a position from short to medium term perspective. I'm expecting a target of nearly 2650 to 2700 in the short term period for Muthoot Finance.
Right, that's with regards to Muthoot Finance. But moving on, you have a Bharat Forge that is in focus as well. Overall, it has been a slightly weak set of numbers that have been reported, and this is mainly owing to the softness that the company has seen in the CV demand. There has been weakness with regards to European operations go, and the defense revenues have been lower as well. In fact, even the order win momentum has decelerated this time around in this quarter. I think it's come in at around 800 odd crores versus 1200 odd crores that we had seen in the second quarter of FY25. The management themselves have guided to a weak outlook for the CV's business across the domestic as well as European operations, with approximately 10% growth that could be expected in North America CV business, and this is in the second half of FY26. In fact, they've said that they would be reviewing their manufacturing footprint in the overseas business as well, owing to sustained weakness in Europe and the demand slowdown in North America. In fact, we did speak to Amit Kalyani as well. Let's quickly listen in to what he had to say with overall business outlook.
We are investing in new capacities to make new products for aerospace, and this will be a significant growth driver for our aerospace business. And we believe that with the customer tie-ups we have and the overall growth of the aerospace industry, and especially the demand growth coming from India and Asia, the supply chain and the value chain also has to move into this part of the world. So we've had two large announcements on aerospace, one on defense, and I think those are all going to be massive growth drivers. And for example, the landing gear line, we are increasing our capacity and doing more value addition for products that we're already supplying. So it's moving from one stage to significantly higher value add. And aerospace, as I mentioned on the call, is that we expect to see our quarterly numbers cross 100 crores this year and grow substantially from there. So we expect to see 30, 40, 50% growth YOY in this business from FY 25-26.
In fact, the stock is down nearly 30% in the last 6 months, if you see. And I mean, it had a peak of almost, a 52-week high of 1804. We're almost 800 points away from that. Osho, do you think these are good entry levels? What are charts indicating? Or do you see further selling pressure that could be coming in terms of a Bharat Forge?
See, overall, this counter have given all the gains that we have seen from the last year, February month. It was approximately around the same zone of 1050, 1070 odd levels. And from there, it has started accelerating towards the zone of 1800 plus kind of a zone. So now in a year kind of a scenario, the counter is again at a same zone. And overall, the technical structure is again showcasing a kind of a strong support for this counter. So there is two strong support for this counter. Firstly, around 1100, 1050, and secondly towards 1000 zone. So I'm expecting that this zone can provide a very strong cushion to this counter, and this is an opportunity to start accumulating this counter in a staggered manner. The coming period from a try to.
So in fact, also, Avinash, let me come to you on a Bharat Forge. With everything that the management has indicated, they have been slightly cautious with regards to the international businesses. CV has been a concern right now. Defense, clearly, it's not that there is loss of orders, but they've clearly indicated that execution is a slight bit of a concern right now. So with the revenues that could be recognized in FY25, there could be some movement that could be happening in FY26 as well. What would you advise investors to do with the Bharat Forge?
No, I think Hiral, clearly execution has been pretty slow in the December quarter. But I think if you see the technical expertise which this company has put out, both in the defense and the aerospace category, I think, it definitely is positioning itself very well for the next, say, 2 to 3 years. So I think, these kind of, things like poor execution in one quarter can definitely hamper the growth in the near term. But longer term, I think there's a lot of runway to be covered, both on the defense and the aerospace opportunity. Our sense is that, somebody who's looking at the next 12 to 18 months can use this weakness to actually accumulate the stock, because once the orders come in and the execution gets back on track, you're going to see a very strong profit traction, both in the overall profitability side. And as far as the CV business is concerned, I think, we'll have to wait for a couple of quarters before growth comes back. But definitely, I think these short-term setbacks are not going to upset the longer-term story for Bharat Forge. So I think, it can be added to the portfolio, but with a longer-term time frame.
Right. Thank you, Avinash, for that. And thank you, Avinash and Osho, for joining the conversation. Hope to see you soon. Well, moving on, Tata Motors has unveiled Open Collaboration 2.0 to turbocharge the next wave of EV adoption in India, to identify hotspots for charging installation and by helping create common protocols for discovery and payment processes. My colleague Tushar will join in with more details from the event.
More than 5 years after Tata Motors unveiled Open Collaboration 1.0 to initiate EV adoption in India, it has now launched Open Collaboration 2.0 to turbocharge the next wave of EV adoption in the world's third largest automotive market. Open Collaboration 2.0 aims to accelerate installation of fast chargers in India, improve quality of public EV charging infra, drive customer awareness, as well as drive seamless accessibility of charging infrastructure in India. Towards this endeavor, the company has announced the launch of Tata EV mega public chargers, which are rated at 120 kilowatt hours. There will be about 500 of these that will be set up across India. And for that, Tata Motors has partnered with 4 charging operators, including Charge Zone Static, Zion, as well as Tata Power within the group. Apart from that, Tata Motors aims to increase the number of charging stations in India to about 400,000 by 2027, and this includes about 30,000 public charging infra as well. According to Tata Motors, 90 to 95% of EV charging happens at home. Now, the company is now focusing on improving the public charging infrastructure along India's highways. Adoption is already at 85%, but a lot is left to be desired.
Thanks.
Fairly homogenized at this point, with CCS2 being the prevailing charging standard. So these chargers will be to CCS2 standards. So therefore, all the EVs that are announced in India right now are the same standard. So there would be no compatibility issue for any of the other EVs that might be that might need to use these chargers.
A big EV push coming in from Tata Motors as well. So that's with regards to the EV story. But moving on the sidelines of India Energy Week, my colleague Vikas Srivastav caught up with Vartika Shukla, CMD at EIL, who speaks about BP and EIL's pact for refining projects, the road ahead for the company. Let's quickly listen into that conversation.
The MOU with BP is exclusive of any other organization. It is singularly between the two organizations, that is BP and EIL. And the intent of the MOU is collaborating with BP in providing our expertise in terms of our services across all domains, wherein they actually are, present, whether it is refining, offshore, onshore, ports, harbors. So that is the intent of the MOU, to give complementary services as a service organization to BP.
So this does not mean that you will be also indirectly participating into the ONGC's upgradation program that BP has signed?
No, I'm not aware of what BP has signed with ONGC. I'm aware of what we have done with EIL and BP, and that is clearly an engineering service kind of collaboration.
Ma'am, can you give some brief about which all geographies that you are looking at right now, and you also plan to diversify into nuclear? You said that you want to participate into projects. So a bit about nuclear and how the international geographies are looking at.
So we have consolidated our position in terms of global presence. We are concentrating in Abu Dhabi, where our offices has grown, our order inflows have grown, and we are also upgraded with ADNOC as Tier 1 consultants. So that's one of our primary focus area. We are also looking at other geographies in the MENA region, wherein we are present. We have re-entered in a lot of territories. As also in Guyana, where we are doing the PMC for the power plant. So we're trying to focus on those areas where there are investments, where there is opportunity for us to be a valuable, stakeholder in the investments that are happening.
Right, so that's EIL to NDTV Profit, but clearly the stock is down almost 19% in the last 1 year. Completely out of time, but that it's a wrap on this edition of Profit Buzzers from Varsha, myself and the team that put the show together. Lots more lined up on the other side. Please stay tuned to NDTV Profit.
Tax regime for individual. In fact, there has been discussion on how to sort of reduce the tax rate.
I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Government is considering to increase the custom duty on the imported finished goods ranging from consumer electronics to medical devices.
And to rectify inverted duty structure, I propose to increase the BCD on interactive flat panel display from 10% to 20%.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company?
Hello and welcome. You're watching Top Trades on NDTV Profit with me, Somit Sarkar. Well, the benchmark index, that is Nifty 50, has snapped its 5-day losing streak and it's gaining up in trade. It's up around 100 points in trade. When it comes to the FNO stocks, if you look at it's Muthoot Finance, which has been the top FNO gainer, up around 6.5%, followed by Godrej Properties, SBI Cards, Vodafone Idea, Jubilant Foodworks and Ipca Lab. Ipca Lab has just come out with the numbers. The stock is up around 4.5%. Jubilant Foodworks came out with its numbers, but it was the strong management commentary that led the stock up 6% in trade. SBI Card is gaining on the back of Macquarie Note, where they have upgraded their rating on the stock to outperform. When it comes to cash stocks, notable names are down in trade, and first it's Natco Pharma is down around 18%, followed by Orchid Pharma down 15%. Both the companies had come out with their Q3 numbers, and the guidance also was kind of weakish when it comes to both the pharma companies, and hence we are seeing such kind of a downtick. When it comes to FNO stocks, PI Industries is the top loser, down 3% in trade, followed by Voltas, which is down 2.6%. Varun Beverages, CAMS, Metropolis down anywhere between, around 2% in trade. Also, the broader indices, if you look at trade today, Nifty Mid Cap and Nifty Small Cap have been zooming and are outperformers when it comes to the benchmark index at least. Well, let's also welcome in Prashant Tapse, the Senior Vice President, Research Analyst with Mehta Equities. Prashant, starting off with, how are you looking at the markets? Is it just a dead cat bounce that we are seeing currently, or do you expect this upside momentum to sustain in the markets?
I think the market is hoping that the Trump and Modi meeting will get some kind of positive sentiment for Indian markets. From the day January 1st, as soon as Trump took his charge in the US president, I think Indian markets started discounting a lot of the geopolitical tensions with respect to the tariff attacks by Trump. So that has led the market to come down a little bit, almost 10% from last 1.5 months. So I think the meeting between Modi and Trump, the market is overall expecting something has to come out in a very positive way. And we have seen last term in 2017 and 2021, Trump has been the best ally for Indian, except a pharma as a sector, but rest of these sectors were very positive. So on the hope of better updates today evening, markets are trading very positive. Technically, again, 22,800 was the level of last January low, and even yesterday it has touched almost the same level, and there has been a strong support to cover back.
Right. Well, the pharma stocks that have been buzzing in trade, firstly, it's Orchid and Natco Pharma. What gone wrong with both the companies? In fact, a lot of pharma stocks have been gaining also. On the positive side was Lupin or Bindu Pharma, which were up in trade. So what has been happening in the pharma space? Let's get in Varsha to get his more detail.
Thank you, Somit. So let me start with, what's the news basis. You see Aurobindo and Lupin, Cipla, Sun Pharma, all the stocks are actually buzzing. So President Donald Trump has announced plans to impose reciprocal tariffs on countries that charge duties on US imports. Now the thing is that Trump might consider exemptions for certain industries such as automotive and pharmaceuticals, and so this is actually good for Indian pharmaceutical companies, and that's the reason why Indian investors are cheering this news. With the US market making up a huge chunk of sales of several Indian drug makers, fear of increased tariff on exports to the country, had sent investors on a cautious footing a few days back, and we saw that most of the pharma companies few days back were actually under pressure. But now that fear seem to be going off, and this is the reason the key stocks in focus. You have Aurobindo supplies up today. Let's see so let's see the contribution of these companies when it comes to US to the overall revenue. So Aurobindo Pharma, if I were to consider, 46% of the business comes from US. Then Cipla has 28% of contribution from US business, Lupin 37, Dr. Reddy's 46, Sun Pharma 32, and Torrent Pharmaceutical 10%. So basically, not having a tariff on Indian rather on pharmaceuticals is actually the good thing for all the pharmaceutical companies, and this is the reason these stocks are buzzing in trade today. But moving on, two stocks, you have Orchid Pharma and you have Natco Pharma who are not doing well today. Now this is on the back of weak earnings that these companies have posted. Let me start with Orchid Pharma. If you see, revenues were down almost 1%, EBITDA was down 24%, margins were at 12% versus 15% last year. Now, though there was a volume growth of 20% year on year, but pricing correction in majority of their products has led to muted sales overall, and their AMS division currently is in the investment phase, contributing to negative EBITDA when it comes to 9-month FY25 numbers. And also, if you see, one of their products has secured, so one of their products which they were actually bullish on, but they've got a delay when it comes to securing a partner in the US market, despite having a product approval from the US. So this is also a key negative thing. Their 7 ACA project, although assurance were given, but now the risk is that the government may not extend PLI benefit to this project. So these are all the con call highlights which I would say negative things which market is not liking, and this is the reason we are seeing Orchid Pharma is down in trade today. Next on my list is Natco Pharma. Again, weak set of numbers. You see, US formulation business degrew 52% for the company, which is a majority chunk of the overall revenue, and that has led to the revenue degrowth. And also because this forms the majority part of the revenue and being a high margin products, you're seeing the EBITDA margin has also dragged down. So because of this one single, that is US export formulation, has led to weak set of numbers when it comes to Natco Pharma.
Right. Prashant, coming to you first, any views on Natco Pharma and Orchid Pharma? Do you track both the counters?
I think yes, technically I track it, but fundamentally due to the Q3 earnings disappointment, the correction of almost 15-20%